Good afternoon and welcome to the afternoon session of the June 2026 meeting of the SEC's Investor Advisory Committee. I'm George Georgiev and I'm the chair of the committee. We have a panel and two recommendations this afternoon, as well as remarks by the chairman at 4:50 p.m. So we'll start with the panel, which will be moderated by Jim Copeland, who is the vice chair of our Investor as Owner Subcommittee.
Thank you so much, George, and thanks to all our wonderful distinguished panelists who are going to be sharing with us today and helping our committee as we think about these issues and perhaps the commission as they think about these issues. So this afternoon's panel is entitled Passive Index Funds and Shareholder Voting. And I've been informed that a passive index fund may be a slight misnomer in the sense that index funds are passive as investors in terms of their investment decisions, but not necessarily as voters or in terms of their shareholder engagement and things like this. So not trying to load the dice on that. That was just sort of the way I've always written about them and thought about them. And what we're really talking about is corporate governance and investor protection and how we think about that in terms of the growing concentration of voting power in a relatively small number of asset management fund families. So we heard Commissioner Ueda talk about that this morning and referencing former SEC General Counsel John Coates' book on this question, but also the shift in composition in asset managed funds, mutual funds and ETFs toward passive or towards index vehicles, I should say, in terms of investing strategy as opposed to more traditional actively managed funds. Of course, indexing is still a relatively new phenomenon. I guess more like 50 years at this point when John Bogle and helped get this going at what's now Rodney's company at Vanguard. And what we've seen, though, is a significant shift. So from 2016 through 2025, index domestic equity mutual funds and ETFs got $2.9 trillion in net new cash flows and reinvested dividends. And actively managed domestic equity mutual funds had net outflows of $3.4 trillion, such that by the end of last year, by the end of 2025, a majority, 52% of all fund investments were held in index vehicles, mutual funds or ETFs, up from only 19% in 2010. So there's a big shift in the market that's taken place. And perhaps unsurprisingly, given this shift and given the fact that economies of scale are driving this and the differentiation when you're tracking a market index is going to be trickier to establish compared to an actively managed fund. We've seen the five largest fund families managing up now up to 58% of investment fund assets, up from 35% at year end at the previous cycle. So we've seen significant growth here, and in almost all S&P 500 companies, one of those five largest fund families is the largest shareholder, and collectively more than 20% ownership, and often up to around 30% even of shareholder votes, given voting patterns in a lot of these companies. So we wanted to explore this. There's been exploration that's been happening over the last 8 years or so on this. Dorothy Lund and my friend Todd Henderson wrote about this about 8 years ago in the Wall Street Journal, and Professor Lund followed up with an article exploring the question, provocatively titled, the problems with shareholder voting, some such, and worked through arguing things like either the funds shouldn't vote or they should pass through the vote, was her argument. I testified about that. I've been thinking about it for some years. I testified it the first time in 2019 in front of the Senate Banking Committee, looking at the interplay between basically all mutual funds, not just passive funds, but sort of the question of agency. And Professor Fish has written about this in multiple articles. The question of agency that we think about as a corporate governance question, agency principal relationships that we see in corporations also exist in these investment company vehicles, and how do we think about that? And I started engaging with staffers in both houses of Congress on this, and when they introduced the Index Act, which has mechanisms of both pass-through or voter choice type voting, as well as mirror voting, wanted to explicate that more and wrote about it about 2.5 years ago in a Manhattan Institute publication. So I'm very interested to hear what our panelists have to say. They've all thought about this from different angles. We're going to hear, I think, some significantly different points of view depending on who's going to go. I will introduce them and do so briefly because those of you following on the website can click the hyperlinks to their fuller bios. So I'm not going to go through all of those today. Also do want to emphasize, though, that our panelists or anyone following online or watching this can submit to our IAC comment file your own thoughts on this, and some of the panelists may do some of their own research as well so that we make sure that that's in front of the committee and the commission. So we're going to start with the Saul A. Fox Distinguished Professor of Business Law at the Penn Carey Law School, Jill Fish. She's no stranger to this committee, although I say that with a little bit of irony, given that she testified or presented 1 year ago at the June meeting of the IAC, looking much more in depth at pass-through voting, but only 5 of those committee members are still on the committee. So for some of us, she may be new, although people who follow corporate law scholarship, she's certainly not new. We're really glad to have you. Then we're going to have Lindsay Keljo, who's the Managing Director and the Head of Asset Management Group and Associate General Counsel at SIFMA, the Securities Industry and Finance Markets Association, which is a leading trade association in this space and can really, we hope, reflect sort of the broad thinking among our institutional investors, including these large asset management fund families. Then we're going to have an attorney, Andrew Friedman, who is the co-managing partner and chair of the shareholder activism practice at Olshan From Wolosky, LLP. This is one of the leading firms representing activist-side investors. These are hedge funds that are trying to shake up corporate management through their investing strategies and obviously, run into these shareholder voting questions. And so Andrew can hopefully elucidate that for us in practice, what he sees. And then we're going to look at have a couple professors who have cutting-edge research that's really just now dropping that they've been looking at on these sorts of topics, particularly the mirror voting where you're trying to get the index funds to sort of match other voters in their voting so that they're voting passively in theory the way that they are investing passively. Robert Bishop, who's the Associate Professor of Law at Duke Law School, has been looking empirically on what mirror voting might have looked like if it had been in place and how it might affect the voting outcomes. And he noticed that for the SEC on their website with Frank Partnoy at Berkeley. And they've got a forthcoming paper that we'll be able to see very soon, or it might already be out there as of today, I think, maybe has been posted online. And then we have finally Nathan Atkinson, who's an assistant professor of law at the University of Wisconsin-Madison School of Law, who's been thinking about, what do we mean by mirror voting? And it's not as simple as we might have thought. He's got a paper that he's working on that's going to be out imminently as well with John Macy at Yale, who's been a vocal proponent of some form of mirror voting. And they go through some of the complexities and what that might actually look like in practice. So I've probably spoken too long already. I'm going to turn it over to Professor Fish and let her get us going.
So is this working? Excellent. So George, Jim, thank you for the invitation to be here. I'm delighted to see so many old friends and hopefully meet some new ones. I'm also delighted to talk about passive index funds and shareholder voting. It's a topic that I've been studying for a long time. I bring to my remarks today the perspective both of an academic and an investor. I've had the opportunity to participate as an investor in the voting choice program offered by Vanguard. So I've actually clicked through and seen what your options are. And I know that's not why you invited me here, but I'm happy to talk about both. As Jim said, by way of background, I teach at UPenn. I've been teaching and writing about securities regulation and corporate governance there since 2008. Before that, I was at Fordham for almost 20 years, and prior to that, I was a trial attorney with the Justice Department Criminal Division and an associate at Cleary Gottlieb in New York. When I talk about voting choice programs today, and I'm going to use the term voting choice, I want to distinguish that from pass-through voting. Today, we have an increasing use of pass-through voting programs that are being offered to institutional investors. In my prepared remarks, I talk about that a little bit in the history, but voting choice is offered to retail investors who hold securities in mutual funds and ETFs. And we've seen the big three, BlackRock, Vanguard, and State Street, giving retail investors the opportunity to participate in these programs on a limited basis, not for all their investors and not for all their funds, but on a limited basis for the last several years. So what is voting choice? It allows a retail investor to select from a curated menu of voting policies. And those policies, or guidelines, are then used to vote that investor's proportionate share of securities in the fund's portfolio. The menus differ among asset managers, but each includes several third-party proxy advisory policies, the opportunity to continue to have the asset manager vote the securities on a discretionary basis, a vote with management option, and possibly the opportunity to engage in mirror voting or to abstain from voting. And Vanguard has kind of switched what it offers on that in the last couple of years. And Nate and Bobby will talk a lot more about mirror voting, right? I want to focus in particular on the voting choice options that are offered through third-party proxy advisory firms, right? Now, there are two potential objectives or values to voting choice programs. One is to address what I've talked about in earlier work as the empty voting problem, right? The mutual fund investors have the economic interest in the securities, but the fund manager or the fund stewardship team decides how those securities are going to be voted. And those decisions historically have been made without any input from the retail investors. And we know that institutional investors and retail investors don't always see things the same way. So I've argued for more input. You could argue that voting choice programs do exactly that, right? For the reasons that I'll talk about, I don't think they do. But another objective, and I think we should be quite clear-eyed about this, is that the big three are currently under attack, right? Along a lot of dimensions, right? They're under attack for engaging in collective action. Some people believe that they are exercising too much power. Some people don't like the ends to which that power is being put, right? So, you know, we've got John Coates' Problem of 12 book, the common ownership literature, the Index Act, Texas Attorney General Paxton's lawsuit against the big three, right? All of those obviously are concerns about the potential abuse of power. If an asset manager can say, hey, it's not me, I didn't make this voting decision, right, that lets them off the hook, right? And these are reasonable objectives, don't get me wrong. But voting choice programs are a flawed solution. And I want to just talk about three reasons why. First of all, these programs don't offer retail investors a meaningful choice, a meaningful way to convey their voting preferences. Second, a voting policy or a voting guideline is inherently incapable of addressing the most consequential issues for investors. You can't have a voting guideline that tells the investor what the advisory firm is going to do with respect to an issue like a merger, with respect to a reincorporation, with respect to a proxy contest, right? But I think we all have the intuition that if any votes count, those are the most important ones, right? Third, voting choice fragments the voice and the power of large institutional investors. And I'll talk very briefly, but there's an extensive literature on the changes that have occurred in corporate governance since institutional investors have been engaging in stewardship, right? So a little bit about the way the voting choice programs work, right? If you're an investor, right, you get the opportunity to click a link and participate in voting choice. Right? And if you do, a menu will pop up that tells you, okay, these are your different options. right? And let's assume that you can tell from the name, all right, I know what vote with management means. I know what sticking with my fund manager means, right? So you click through to the other policies that are offered. That's going to take you to the proxy advisor's website, right? And you will get the proxy advisor's voting guidelines, which typically runs 60, 70 pages, right, and list all of the things. We vote against poison pills, or we vote in favor of separating the chair and CEO, or something like that. Actually, the language is a little bit vaguer than that, right? But there's an extensive detailed description, right? Egan-Jones wealth-focused policy, which BlackRock and Vanguard both offer as an option, it's 75 pages, right? Given retail investors' propensity for engaging with disclosure, let me suggest to you that retail investors, by and large, aren't digging into those policies and comparing and trying to figure out what's the right policy. Right? Instead, what they're doing is choosing based on the name. Adriana and I have written about the power of names in influencing retail investor decisions. Right? So if I'm choosing based on the name, I know what I'm going to pick. The wealth-focused policy, right? I'm investing to make wealth. That's the policy I want. But of course, names are inherently capable of misleading. And even if they're entirely accurate, there's only so much information that a name can convey. So, for example, Glass Lewis's ESG voting policy, right? I might think, even as a retail investor, I have a pretty good idea what ESG means. But does that tell me the policy with respect to reincorporations? Does that tell me the policy with respect to even something like disclosure of corporate lobbying expenditures, right? What exactly is an ESG policy, right? So I'm not getting a lot of information. And, early research in this area, Dorothy Lund, Alon Brav, and others have an empirical paper in which they look at these voting policies, and they say there are some little traps, some surprises. You pick the Glass Lewis ESG policy, and it turns out that they vote against the company's auditors 34 to 74% of the time. Now, I don't know about you, but I wouldn't get from an ESG policy, I wouldn't think, oh, this is a policy that refuses to ratify the auditors. Right? So, not a whole lot of information. In addition, the guidelines don't actually enable investors to predict voting outcomes. Right? BlackRock explains, a voting policy is a document that provides principles-based guidance on how a vote may be cast on certain agenda items. Voting policies are not exhaustive and are applied on a case-by-case basis. Well, that's great. And in fact, if you look at the actual guidelines, you'll see lots of them say, right? So Egan-Jones, again, in its wealth-focused policy, says we're going to consider anti-takeover measures on a case-by-case basis. But if I'm an investor, I don't know what those cases are. And a retail investor doesn't get access to the proxy advisor's firm-specific reports and recommendations. They don't get access to real-time information on how proxy advisors' recommendations aren't even released to the general public unless there's something that makes its way out through the press, right? And they're not given any opportunity to influence those policies. So, ISS for years was famous for reaching out to its institutional clients and saying, what do you think about separating the chair and CEO? What should our policy be? Right? But these policies are being developed without any input at all from retail investors. Right? So the opacity of these programs is heightened in the case of individual significant votes. Right? The proxy advisors themselves acknowledge these guidelines don't apply. But essentially what that means is if I choose an advisory policy, on the most consequential votes, I'm delegating blind to a proxy advisory firm. Now, maybe some of you remember the fact that proxy advisors haven't always been the political, good child, right? They've been criticized for conflicts of interest and for doing a sloppy job, and whether or not those criticisms are well-founded, right? People like, current Commissioner Ueda have said, I don't think institutional investors should delegate their votes to proxy advisory firms. So it's too dangerous for institutional investors, but it's okay for uninformed retail investors to delegate to the proxy advisory firms. Right? Finally, voting choice reduces the heft of the big asset managers, their ability to leverage their voting power to engage productively with their portfolio companies. Informed institutional engagement, both through voting and private meetings, has dramatically reduced managerial agency costs and has improved management accountability. Right? Recent empirical work, again by Andrei Malenko, Nadia Malenko, and others, demonstrates that this fragmentation of institutional voice has the potential to weaken the ability of funds, the ability of institutional investors to monitor management. I want to make one final point. The title of the session conveys that proxy choice or voting choice programs are a specific response to concerns about index funds. Right? And the empirical papers that we're going to hear about later talk specifically about index funds and what would happen. And of course, the Index Act does the same thing. Right? So I want to make just a couple of points on that. First of all, the idea that index funds somehow don't engage or are uninformed voters, it's a kind of superficial reaction. Right? Index funds, or more accurately, asset managers with a large proportion of index funds have dedicated asset stewardship teams. They have positions on both general governance issues and specific consequential votes. They articulate those positions in white papers, many of which are publicly available. These are not uninformed voters. This is not blind or rubber stamp voting. In addition, right, index funds are part of an asset manager's overall package of assets, right? So you've got index funds and you've got actively managed funds in the same company. In many cases, the voting is done by some sort of stewardship team. Even when it's not, in the case of, say, T. Rowe, active managers can talk to passive fund managers, right? So the idea that these are somehow second-tier investors and therefore they should be disenfranchised is misguided. Right? At the same time, and Adriana has written about this, right? This very category of index funds is problematic, right? It's not like there's a world in which there's index funds and there's everybody else, right? Vast majority of what are so-called actively managed funds are in fact closet index funds. Maybe there are a couple of actively managed positions, but most of the security is not, most of the portfolio is not actively managed, right? So when we think about, well, who are we going to disenfranchise? And then who are we going to hand greater power to? The categories, the methodology matters a lot. And this is something that our empirical scholars are going to have to deal with when they try to predict the impact of mirror voting. Absolutely. I welcome your questions.
Wonderful. We're going to turn it right over to Lindsay, and we'll get questions at the end. I'll make sure that everyone's got enough time. So.
Thanks, Jim. And thank you to the Investor Advisory Committee and the Investor as Owners Subcommittee. I'm Lindsay Kellio, the head of the Asset Management Group at SIFMA. SIFMA AMG represents the asset management community whose members serve millions of investors through mutual funds, ETFs, retirement plans, institutional accounts, and other investment vehicles. I've been asked to discuss the rise of index investing and increased ownership levels from an industry perspective. To understand the current debate, I think it's helpful to begin with a simple observation. The rise of index investing and increased ownership levels are not separate phenomena. They're closely related developments that stem from one underlying reality. Investors increasingly choose professionally managed, low-cost, diversified investment products as a preferred way to participate in the capital markets. As a result, investors have benefited, and the capital markets have benefited as well. Over the last 15 years, the growth has been dramatic. According to the ICI, index mutual funds and ETFs grew from approximately 19% of fund assets in 2010 to approximately 52% by the end of 2025. And between 2016 and 2025 alone, indexed domestic equity mutual funds and ETFs received approximately $2.9 trillion, as Jim mentioned in his opening remarks, in net new cash flows and reinvested dividends. This growth was not the result of a regulatory mandate or a policy decision that a handful of firms should become large shareholders. Rather, it reflected millions of individual decisions by investors who were seeking diversification, lower costs, transparency, and long-term investment performance. Discussions about passive investing often begin at the end of the story rather than at the beginning. We observe that ownership is more concentrated among a relatively small number of asset managers, and we ask whether that creates governance concerns. Perhaps that is an understandable question, but it is important to recognize that this development emerged as a byproduct of investor choice and the growth of pooled investment vehicles. And it's also important to recognize that the assets belong to the end investor, not to the asset manager. It's also important to distinguish between common holdings and the size of a manager's ownership position. Index construction helps explain why many index funds hold the same companies and why larger companies receive larger weights in market cap weighted indices. Asset managers appear higher on shareholder lists primarily because they manage larger pools of client assets. These ownership patterns are the product of index design and investor choice, not coordination among managers in selecting investments or exercising voting rights. Mutual funds and ETFs are now a core component of retirement and household savings in the United States. Tens of millions of Americans own fund shares directly or through retirement accounts. Every share of stock carries voting rights. These rights do not disappear when an investor chooses to own a company through a fund rather than directly. The practical question becomes who exercises those rights and under what framework. Historically, many investors delegated that responsibility to fiduciaries. In the mutual fund context, the investor owns shares of the fund, and the fund in turn owns shares in the underlying portfolio companies. Mutual fund advisors are expected to manage fund assets and exercise voting authority in what they believe to be the best interest of the fund and its shareholders. Whether one agrees with every voting decision, that framework is grounded in the idea that investors have entrusted a fiduciary to act on their behalf. While all investment managers seek to protect and enhance value for their clients, index fund managers generally cannot respond to concerns about a portfolio company by selling their shares. As a result, proxy voting can serve as an important mechanism for accountability, oversight, and protecting the long-term interests of the millions of investors who invest through these diversified funds. However, as index investing has grown, it is entirely appropriate to ask whether existing governance arrangements continue to serve investors effectively and whether improvements can be made. Those are precisely the questions we should be discussing today, and I'd like to offer a few observations on the debate. First, even taking into account the rise of index investing, voting outcomes remain highly decentralized. Public companies are owned by a diverse set of shareholders, and no single participant determines outcomes alone. Corporate elections and shareholder proposals remain the product of a collective voting process involving investors with different objectives, incentives, and investment horizons. Similarly, public discussions frequently portray large index managers as exercising coordinated influence over corporate America or advancing particular political, environmental, or social agendas. The empirical record reflects a different reality. Stewardship teams frequently disagree with one another. They disagree with proxy advisory firms. And increasingly, they're providing investors with opportunities to express their own preferences through voter choice programs. Whatever one's views on particular voting outcomes, the voting landscape is far more dynamic and decentralized than many public narratives suggest. It's also important to distinguish between stewardship and activism. Activist investors play an important and valuable role in our markets and often create value by challenging management teams, proposing strategic changes, or identifying underperforming companies. Non-activist investment vehicles, including index funds, serve a different purpose, providing broad market exposure and long-term value creation across diversified portfolios. One can believe activism contributes positively to market discipline while also recognizing that fiduciaries representing diversified retirement savers may appropriately approach voting decisions through a different lens. Against this backdrop, policymakers and market participants have increasingly explored alternative approaches to mutual fund voting. These include pass-through voting, voter choice programs, mirror voting, proportional voting, and abstention. Some industry participants have already begun creating offerings and providing investors with opportunities to participate more directly in voting decisions or expressing voting preferences. These efforts reflect a recognition that investor preferences vary and that technological developments may create new opportunities for investor participation. At the same time, every proposed alternative involves trade-offs. Consider mirror voting, which has received considerable attention in recent years. Under mirror voting, a fund votes in proportion to the votes cast by other shareholders on a proposal, and it's often presented as a neutral solution because it reduces the role of fund advisors. But mirror voting does not eliminate influence, it reallocates it. It substitutes the judgment of other voting shareholders and proxy advisory firms for the judgment of the fiduciary selected by the fund investors. In some circumstances, it may even increase the relative influence of the most motivated participants in the vote, including activists, insiders, and other highly engaged shareholders. The key question is not whether influence exists, it's whose influence matters most. Ultimately, the Commission should be cautious about mandating any single approach to fund voting. The debate over pass-through voting, mirror voting, client-directed voting, or traditional fiduciary voting is often framed as a search for the right answer. But each approach involves meaningful trade-offs. Investors have different objectives, levels of engagement, or preferences regarding participation in the voting process. Given this diversity of investor preferences and the continuing evolution of voting technologies and market practices, the better course is to preserve flexibility and allow asset managers to offer a range of approaches, subject to their fiduciary obligations and other legal requirements. This, in my view, is a central policy question. The debate should not be framed as a choice between influence or no influence, because influence is inherent in shareholder voting. Rather, the objective should be to maximize investor choice and participation while preserving the core benefits that pooled investment vehicles provide, including diversification, professional management, and economies of scale. Any reform should be evaluated holistically with careful consideration given to the implications for investor choice, costs, operational complexities, and investor outcomes. I look forward to the discussion. Thank you.
Thank you so much, Lindsay. Andrew, we'll turn it straight over to you.
All right. Thank you, Jim, and thank you to the committee for having me here. I'm grateful for the opportunity to participate in today's discussion alongside my distinguished fellow panelists. This topic sits at the intersection of market structure, fiduciary duty, and the fundamental question of who speaks for investors in corporate America with their votes. Let me be very upfront and direct about my perspective and how I'm situated. I represent investors who are highly engaged in corporate governance. Some may even refer to them as activist investors or active investors. These aren't climate activists, these aren't social activists. These are investors who study companies carefully, take concentrated positions in underperforming companies generally, and advocate for change when they believe management and boards are destroying value or at least failing to optimize their company's full potential. I'm aware that my professional background as an advisor to these types of investors could lead some to view my support for mirror voting as self-interested. I'd ask the committee to evaluate the argument for mirror voting on its merits, and I'll do my best to present it in as neutral and non-biased way as possible. Passive index funds now account for roughly a quarter of all proxy votes cast across corporate America each year, depending on which way the wind may blow at any given time. The top asset managers, BlackRock, Fidelity, State Street, and Vanguard, dominate the U.S. market with over $21 trillion in assets under management, $18 trillion of which is invested in passive index funds. The investors in those funds, millions of everyday Americans, generally did not choose those fund managers as their proxy agents on contested governance matters or even key topics like executive pay packages. They chose them as portfolio managers. It's a meaningful distinction. A large part of this immense control of corporate America stems from shares held in passive funds that millions of Americans invest in. Yet, the voting decisions on those shares are being made not by the underlying beneficial owners, for the most part, but by asset managers who may have their own institutional incentives, relationships, and viewpoints that don't necessarily align with the underlying investors' interests. So one of the key tenets of mirror voting is to make voting outcomes in corporate America more representative. Again, this isn't a partisan point, it's a structural one. The question we should all be asking is what is the appropriate voting structure to maintain corporate accountability and an efficient and productive capital market? I think, or at least I hope, we can all agree that corporate governance works best when directors can have confidence that election outcomes reflect shareholder preferences. And importantly, that those very directors guide their decision-making accordingly. That's how accountability is promoted and maintained. Now, mirror voting is a straightforward mechanism. If a passive index fund is unable to determine the voting preferences of its underlying investors, the asset manager would cast votes in the same proportion as other non-passive shareholders. It doesn't eliminate the voice of passive funds. It doesn't hand votes to any particular category of investor. It causes passive funds to reflect the aggregated choices of the market's engaged and economically invested participants, rather than substituting the judgment of a small number of asset management executives. The empirical record supports the proposition that this would not meaningfully distort outcomes. Research submitted to this very committee found that if all passive and indexed funds had switched to mirror voting during the previous 2 decades, there wouldn't have been a meaningful impact on voting outcomes in the vast majority of cases. That finding should give plenty of comfort to those concerned that mirror voting is simply a Trojan horse for any particular governance agenda. The data suggests it's not. Now, I also want to address, and I'm keenly aware of, the stewardship counter-argument. I take seriously the opposing view because it's not without merit. Critics of mirror voting argue that permanent passive investors are properly situated to assess long-term risks and returns and are therefore appropriate stewards of shareholder rights, including on proxy voting and engagement. Long-term diversified holders can provide a stabilizing voice in corporate governance. This isn't an outlandish position. But that argument presupposes that the judgment of a handful of asset management stewardship teams, however engaged they may be and however thoughtful they may be, is superior substitute for the aggregated preferences of an economically incentivized market. That's a significant claim and arguably places enormous, largely unaccountable power in very few hands. The question isn't whether passive fund managers are capable of the good governance judgments. Many are. Look, I have the utmost respect for the teams at the big 3 passive institutions. I know the individuals there all very well. From time to time, we get together on Zooms or team meetings, and we share our experience and perspectives on important trends and key topics. They're a thoughtful bunch, highly engaged, and have a solid rationale generally for the policy positions that they take. The question is whether the current system is the right default allocation of voting authority. I contend that it may not be. I want to be clear about what I'm not arguing. I'm not arguing that mirror voting would or should help any particular class of investor win proxy fights. The evidence supports the conclusion that mirror voting by passive funds would help align financial incentives of managers and shareholders without unduly encouraging social and political activism. That cuts across the board. It's not a mechanism designed to favor hedge funds, ESG advocates, or management. It's a neutralizing mechanism. Mirror voting is not inherently pro-activist or pro-management. If management makes a compelling case, mirror voting may in fact strengthen support for the incumbents. If shareholders are dissatisfied, mirror voting may strengthen support for the change they seek. The principle here is neutrality. The objective is to let shareholder sentiment express itself more accurately. I'm also not arguing that pass-through voting, allowing beneficial owners to direct their fund manager's vote, is an inferior method. It's not. A robust pass-through voting regime would be an ideal solution, perhaps, and I would encourage the committee to consider it as a complementary measure. Again, thank you for having me here, and I look forward to sharing some further thoughts and questions.
Wonderful. Thank you, Andrew. And we will now turn over to Professor Bishop. And he's going to have a PowerPoint, since he's got empirical stuff he wants to cover. It should be up there. There we go.
Yep, perfect.
Oh, and Edwin, who, as you see from UVA Law, is also now a co-author with Professor Bishop and Partnoy on this work.
Thank you, Jim, for the invite, and thank you to the IAC members for the opportunity to have this discussion. So I'm a professor at Duke Law School, and along with Professor Eddie Hugh at UVA and Professor Frank Partnoy at Berkeley, we set about to study mirror voting. So much of the conversation on how index funds should vote up until this time proceeded theoretically, and we provide sort of the first large-scale empirical study attempting to fill that gap. So slide, please. And I think that now is an important time to have this conversation because what we're seeing are a variety of proposals that are being put out, proposals that include direction on how index funds should vote, proposals on whether or not retail shareholders should simply default to management. There have been arguments that index funds should simply not cast votes, but there's been little empirical study of this. Slide. Keep going. And so what we try to do is study this empirically in the following fashion. We're going to take all of the votes that have been held on all items for the previous 20 years, so 2005 through 2025. And what we're going to do is simply retabulate vote counts to give a first order estimate of how various proposals that have been put forward would alter the outcomes on votes. We're going to consider 4 different counterfactual voting scenarios. One is going to be simply doing a pro rata mirror of the rest of the market. The second is going to be to reassign index votes to how management votes. The third is going to be to assign the index votes to one of the proxy advisors. And the fourth would be to abstain. I want to make very clear here that all we're doing is retabulating historical votes. This is not a true counterfactual analysis in the sense that there would, of course, be strategic behavior in a real world where we had a mirror voting system, but it does provide sort of a first-order estimate of how these proposals might change. Slide, please. Slide. Yeah. Again, caution that past performance does not predict the future, but I think that it does give some guidance and sort of frames the narrative in terms of how these various proposals would impact outcomes. So, slide. So again, what we're going to do is we're simply going to take all of the votes cast between 2005 and 2025. We're going to link that to all of the voting outcomes for, against, and abstain, fund by fund. And then we're going to look at, if we were to reallocate votes, how the outcomes would have changed. So, slide. So first off, we have 3 investor types that come to us from the literature. The first is going to be an index block, which is just going to be noted as an index fund via CRISP. The second is going to be funds noted as passive. And the third are going to be institutional investors, 13F filers. One point that I want to make here is that we're taking the traditional academic definitions of this as understood in the finance journals. And so to the extent there's certainly debate about, who may be active, who may be passive. Jill mentioned several points, quite accurately on questions about who's actually indexed and who's not. We are simply going to take the academic definitions for the purpose of this exercise and retabulate. Slide. And so our strategy is incredibly simple. We just take the voting block that we care about, we subtract it out from the voting totals, and then we're going to reassign that vote and count up who won. Slide. And we're going to mirror this off 4 different outcomes. One is going to be a market mirroring strategy, where we're going to look to mirror the index block to everybody who's not indexed. The second is going to be to follow management's recommendation. We take the index vote and we assign it to management's recommendation. The third is that we will assign it to either ISS or Glass-Lewis's recommendation. And then finally, we will look at what happens if the index block or the various voting blocks abstain. Slide. And again, our key measure here is just going to be, did the votes change, right? To what extent would this retabulation lead to a different real-world outcome? So, slide. So we're going to focus here for the purpose of the presentation solely on index funds. We've just posted the paper to SSRN with the full results for the passive and the institutional investors as well. But we'll focus here on index funds. So first off, we're going to compare what happens if we were to reassign index funds to one of the 5 different voting strategies. And what we're going to find is that by far the most stable strategy, in the sense of the fewest number of flips, comes to us from mirror voting. So of all of the 600,000 plus votes held in the previous 20 years, if you were to just retabulate the votes and assign the index block to vote pro rata with the non-index block, a total of 12 votes would change entirely. And again, there's no particular management or anti-management bias on a market mirror vote. 16.7% of the votes change anti-management. So a majority of the vote changes that would come from a market mirror are actually pro-management changes. We're going to see larger percentages, larger flip rates and outcomes from any of the other strategies: full abstention, management deference, ISS or Glass-Lewis. And I'll also note that in the abstention, the ISS, and the Glass-Lewis situations, all of those mirroring strategies lead to strongly anti-management flips. So this slide works. One additional point that we'll point out, because one question that has been raised is about whether or not these funds should simply abstain. In the event they abstain, what we find is basically 10% of items that are voted on would not make quorum. So as a practical matter, having these votes cast in some fashion in order to have quorums and actually be able to proceed with normal business of the firm is important. Flip. So in terms of where these flips come, if we look just at index fund reassignments and we break out the categories, no director elections flip if we were to reassign the index fund to pro rata. 10 management proposals flip, 2 shareholder proposals flip. In terms of these, half-ish are say-on-pay votes. Several other are bylaw or charter amendments. In terms of where the flips occur, the majority of them do occur on what we deem contentious items. And by contentious items, we just mean those kinds of items where the management gives a different recommendation than either ISS or Glass-Lewis. Slide. So studying the flips is challenging in the sense that there's only 12 of them in 20 years. It's very hard to try to extrapolate any meaningful information from a data set that is essentially all zeros in the Excel. And so instead, one of the things that we look at is the question about, all right, so if the votes don't flip, how much does the vote actually move? And so what we do is we reassign the index fund to a pro rata mirror vote, and we look by voting category, and then we look at the largest changes by voting category for the percentage that the vote outcome would change, and we order them. And the 99th percentile cutoff for the largest changes in votes category by category is almost exclusively under 1%. Social 14A proposals 1.32% change in the overall floor percentage, but other than that, they're all deeply under 1%. Slide, please. And then one thing that we wanted to do was sort of address several of the different questions that have been raised about sort of edge cases with mirror voting. One idea has been that that mirror voting would have a particularly strong effect in low turnout meetings. We test that by simply deciling the turnout range at meetings and asking where the flips occur. The flips do not, in fact, occur at low turnout meetings. The flips are roughly evenly distributed across meeting turnout. Slide, please. It's been raised also this idea that mirror voting will simply amplify governance activists. So we look at flips in fights where we have activists filing. We bin it by the amount of stock that the activist holds. We observe no flips in any situation. Slide, please. We then look at whether or not mirror voting for index funds would cause changes in the 14A shareholder proposal process. For social and environmental issues, we look at the change in the total vote depending on how much you have a large investor who cares greatly about this. Again, the changes are about 1.3% in total of the floor vote, so relatively minimal. Slide, please. We then look at it across voting thresholds. So many items that are voted on obviously have majority voting requirements. We look at it for whether or not our study incorporates whether or not there are higher voting requirements. We find, again, similarly little indication that there would be large changes from a mirror voting regime for index funds, even for the supermajority items. Slide, please. And so to close, what we report is sort of the normative, we defer the normative question here about mirror voting and index funds, but what we're trying to do is establish sort of a baseline of empirical facts by just reporting retabulations for the previous 20 years. What we find is of the proposals that have been sort of put forth publicly, that mirror voting for index funds appears to be the one that, at least under a retabulation, would be the least disruptive to voting outcomes. So thank you, and I look forward to the questions.
Wonderful. And Professor Atkinson.
Great, thank you so much.
He's also got a PowerPoint slide. Yeah.
I also have some slides, and apologies in advance. I didn't know I wouldn't have a clicker, so you'll hear me say next slide many times. So thank you in advance over there for all my careful clicking. And so as is brought up, this is joint work with John Macy. He was supposed to be here in my place, and a couple days ago things got switched around, and so I'm the pinch hitter. And so what we're addressing in this paper is, I think kind of follows very nicely from Andrew and Bobby, and kind of asking what are we trying to achieve in mirror voting? And oftentimes it's this conception of neutrality in some sense, and we're trying to understand what exactly is that neutrality, is it achieved, and one of our big takeaways is things are maybe a little bit more complicated than we might think. So the slides, sorry. And so I guess I can start going with that. And so we can think about mirror voting oftentimes as with the goal of trying to achieve this neutrality, right? That we want to take some passive investors or index investors and basically have them defer to the active market. And so I'm not going to take any strong positions about whether those are the index funds or asset managers more generally, and instead, thanks so much. Think about what it is. So can you go to the next slide, please? So if we look at, for example, the Index Act, and I'm going to give you some language of mirror voting that's proposed or actually implemented, we see here that the instructions are to vote the uninstructed covered securities in a manner that is proportionate to the vote submitted on the matter by all other security holders of the registrant. And next slide, please. Similarly, Vanguard, in some of their funds, notes that the votes will be proportionate to votes will be based on the votes that have been cast. Next slide, please. And State Street, trustees vote the voting stocks of each issuer in the same proportionate relation to how shares are voted. Next slide, please. And so the goal of these mirror voting policies is very much around this idea of neutrality. Next slide, please. And the way the Index Act puts it, State Street, Vanguard, I think our discussion we've had thus far is really about this instruction neutrality, matching how the actual shareholders and whatever we define the target class. I'm just going to simply say active and passive, but we can have the target and mirroring classes be whatever we'd like, is proportionate to the votes submitted on the matter. Next slide, please. We're going to kind of question whether that's actually what people mean, and instead another question, and we think which is actually more true to what the discussions on mirror voting are, is what we call outcome neutrality. So we asked the question, suppose that the active market, the target market, were the entire market, and then ask whether something would pass, right? Do we have a board member elected? Does a fundamental transformation happen? Say on pay, whatever have you. And then mirror voting as we see it, properly interpreted, would be cast your votes in order to actualize that. The big takeaway from our paper is this instruction neutrality, as we see in the Index Act and Vanguard and State Street, is not equal to outcome neutrality, and that's just a mathematical fact that we show, and that voting according to outcome neutrality or instruction neutrality will and can violate outcome neutrality. And so we're kind of thinking about a different baseline than Bobby and his co-authors. They're looking at what actually happened and comparing what would happen with the retabulation. And we instead are asking, what would happen if you focused only on the active market as your baseline? And now asking, does the addition of the passive fund change things? Next slide, please. And we can see this in a very simple example. So let's take a firm that's a 100-share firm, and there's 50 shares in the active market, 50 in the passive market. Again, the passive market we're going to imagine is mirroring here. Next slide, please. And here's a obviously unrealistic example, but makes the point very clearly. Suppose the active market votes 1 share for, and 49 shares don't show up, right? These can be broker non-votes. They just aren't voted at all. We have something along the lines of 10 to 15% of shares are normally not voted through broker non-votes. Now let's consider something that's like a fundamental transformation. So we're talking a merger, a charter amendment. The voting standard, at least the default voting standard under Delaware corporate law, is going to be 50% of all shares outstanding. And so we looked at just the active market here. We said, well, there's 50 shares in the active market. Half of that would be 25 shares. We get 1 share voted for, 49 are absent. Clearly, this fails if we treat the active market as the entire market. Next slide, please. Now, if we follow the Index Act or State Street or Vanguard's language here, it says vote proportionate to the votes submitted, right? These absent votes are never actually submitted. And so the 1 vote that is submitted is a vote for. And so if you now mirror that 1 vote, you vote 50 votes for. Next slide, please. So the passive shares now contribute 50 votes for, along with that 1 vote for. This outcome passes despite only receiving 1 positive vote from the active fund. Now, of course, right, this is a very extreme example to make the point, but this is how we can violate outcome neutrality, is that we're looking not actually at the full slate of all shareholders, but only those that cast votes. There's going to be a fundamental disconnect between what we're seeing in terms of the votes and actual outcome neutrality. We can contrast this what we would call outcome neutrality. So next slide, please. So suppose we try to actually mimic what the active market does, right? Again, if with this neutrality, I think that Andrew was noting, if we wanted to achieve this neutrality, we would look at the active market here, next slide please, and we say, well, look, this should fail, 1 vote for out of 50 total active shares. And so we're gonna vote to somehow maintain that outcome. Next slide, please. And so we'll start by looking at the aggregate and say, well, we need to keep this number here below 50 shares, right? So we don't reach the threshold for a fundamental transformation. And so, next slide, please. The passive fund now can vote 49 shares against, or 49 shares absent, or 49 shares abstaining, and will actually achieve this outcome. Next slide, please. And so this is a clear case where instruction neutrality and outcome neutrality differ from one another. Next slide, please. And again, this is an extreme case, of course, but illustrates the point. What we're going to see is that if there's any absences in the market, and we're using this this proportional mirroring strategy, it's going to mathematically and mechanically lower the threshold for fundamental transformations. It'll have different effects also on different various voting standards. I'm focusing today on just fundamental transformations, right? The most important things. Our default statutory threshold is going to be 50%. So if you're just doing default Delaware corporate law, this is going to lower it. So next slide, please. And we can kind of see how this is going to lower it in a mathematical manner. And so what this is going to show here is the effect of this proportional mirroring on the effective threshold, right? So the effective threshold we have is a 50% threshold. So you need 50% of all shares outstanding to pass a fundamental transformation. And that's represented here by this horizontal dashed baseline. On the horizontal axis here is going to be the size of the passive market, right? This is the mirroring market, those who are looking at the active market. And next slide, please. What this is going to show is that 10% of votes are absent votes. So these are retail investors who are not voting their shares, and so their brokers can submit them as broker non-votes for something like a routine auditor, but then they're not going to be vote on a fundamental transformation. This blue line here is going to show what the actual effective threshold is for a fundamental transformation. So for example, if we take a 50% active market and 10% broker non-votes, it's going to lower the effective active threshold to about 44-45%, which means now we can pass a fundamental transformation with only 45% of the active market approving it. So even though the majority of the active market is not approving something, it'll lower the threshold. Next slide again. And this is going to be exacerbated if we have a higher number of absences. 10% is roughly around average, but we do see sometimes 20 or 30%. And so we're going to have this fixed and mechanical effect of this proportional mirroring, which is going to lower the threshold and make it easier for these fundamental transformations to pass. And so we need to be careful when we're thinking about mirror voting. If the goal here is outcome neutrality, actually trying to say, look, we want these funds to not be changing the outcomes, then we need to take into account that actually the effect of the various voting thresholds in state corporate law, whether it's all shares outstanding, whether it's a majority of shares cast, and those can have different effects. Next slide, please. And so we do a lot more in the paper, but the big takeaway I think for us today is that This proportional mirroring, as contemplated in the Index Act and also as we actually see from State Street and Vanguard, is actually going to lower the threshold to pass these sort of fundamental changes. And we contrast this with what we call outcome neutrality, which is going to ask the question of, let's look at only the active market and now determine votes from there. There's a lot more in the paper, so we give kind of the actual calculations. If you look at the paper, it might look quite mathematical. It's not. But, these are denominators that are shifting around, so we can actually treat those seriously. We give some language also that you might look at if you actually wanted to implement outcome neutrality. And I think there's also some really interesting questions around common interpretations of fiduciary duties for funds. And there are some cases where the only way for a passive fund to truly be outcome neutral is to actually not vote their shares at all, which kind of can call into question some of our interpretations of fiduciary duties and whether you have to actually vote your shares under the 1940 Act. So the paper's available online. We also have in the Harvard Corporate Governance Forum today for a short blurb. So thanks so much, everyone.
Thank you. That was very illuminating. All five of you, I think, really helped me think about this more carefully, and I hope that's true for the rest of the committee members. We've got, did we get 5 extra minutes since we started 5 minutes late? Does that work? Okay, so we've got, I think, about 43 minutes or so left to go. I'm going to start with a few questions, but I do want to make sure all of our IAC members get a chance to ask questions who want to. So you can go ahead and start flipping your name tags up if you have a question, and I'll try to jot down the rough order that I see them so you can get your questions in if you have them. I guess I'll start. Maybe this is for Professor Bishop and Mr. Friedman, but if I see your paper, if I read your paper correctly, putting aside the sort of theoretical complaints we just heard about that these things can affect, if the change is this minimal to go toward mirrored voting, what is the affirmative case for why we need it?
Definitely. So I think a couple of different things. So I think first off, what our paper just tries to do is study the various regimes that it put forward. We suggest that to the extent that people are looking at one of these regimes and actually trying to pass one of them, that this would be the least disruptive. And so to the extent the goal is to minimize the disruption, but also to do something, mirror voting, pro rata mirror voting off of the market for index funds appears to be that. I think that's one part about it. And I think, another part about it might be that to the extent that you end up with pass-through voting or other these things rising, you end up in a situation where to the extent that you pass the vote through to, certain underlying beneficial owners for index funds, for those people who, choose not to log on and select their votes, it would offer sort of a non-disruptive way in order to have those votes still cast and not disrupt quorums and the like, but nevertheless to allow the votes to go forward.
Yep, and I would just add to that it's not a matter of necessity, it's a matter of what's, in my view, the best alternative available. I think pass-through voting has its practical limitations, and the mirror voting seems, and from a lot of what I've heard even today, seems to be the application that really could address what the root issue is, and that's the rising tide of the institutional vote at public companies.
And of course, if I'm understanding this correctly, what you're looking at, Professor Bishop, with your paper is a snapshot, of course, in time. If that share of the vote that's implicated by a decision rule like this were to move, it would have a more significant effect. I mean, we saw with Professor Atkinson's graph on what those thresholds looked like. The higher that horizontal axis went out there, the more passive share you got as a percentage of the vote, the more these things would matter, even if they haven't mattered that much up to date, right?
Yeah, certainly so. And I think that if you read work from people like John Coates and many others about sort of the rise of the size of the voting blocks of these large index funds and the like, what this would do is sort of stabilize that, and to the extent that this becomes an amplified problem in future years, it would sort of stabilize it as of now, and then sort of adjust for it going forward.
Yep. That was going to go next to Lindsay and/or Jill to sort of respond.
Yeah, so first, thank you very much for presenting your data there, Professor Bishop. I would love to connect with you because I think our members have also been doing much of this research, and I think from our analysis, it actually would change the outcome for dozens, probably dozens of votes each year when we're talking about the non-routine matters. And it'd be great to look at it. And it could actually be because of the issues that we're talking about here in terms of how the outcome would change based on what the thresholds were to begin with. And what I'd also like to say about, this concept that we should only be looking at the outcomes of the vote and whether or not it would change, I think that's not necessarily the right sort of baseline question, because even if the outcome wouldn't change, there could be situations where even small shifts in voting power would still influence the corporate governance outcomes. So there could be situations where, for example, shareholder proposals will appear like they're gaining momentum, so the private settlements will happen with management, or there could be situations where there could be zombie proposals that hit the threshold to be reintroduced the following year, even though the support for it was actually relatively low. So it's obviously important to sort of look at this, and I think each one of the proposals or different options that we have on the table have, potential benefits and also these potential issues that we need to consider, and I just want to make sure that we're sort of framing it that way as well.
Any thoughts, Professor Fish?
Well, Jim, you started off with a question that was on my mind, which was, if this doesn't make very much difference, why are we taking it so seriously? I think that's a fair question. I think it's a fair question, particularly since what we're talking about is disenfranchising shareholders. We're saying there's a whole category, and the data tell us the category is getting bigger, of people who are invested through index funds who essentially we're going to say you don't get to vote. And I think it's also important what Lindsay said. When people invest in an index fund or any mutual fund, right, they're delegating the authority to make investment decisions, but arguably they're delegating the authority to make voting decisions as well. And I think that's part of the reason that we've seen the big asset managers build up their stewardship teams, share their analysis, right? That's something that they are selling to their potential customers. So essentially what you're saying is, okay, you can't compete on that, right? Investors can't delegate, they can't benefit from that. And in fact, if what they want is the low-cost investment opportunity, they've got to give up voting rights, right? We know actively managed funds typically have higher expense ratios, right? If I want my fund manager to be able to vote my shares, I've got to invest in the active fund. So we've also, I think, got to think about those market knock-on consequences.
Thoughts? Lindsay brought up shareholder proposals, and of course that was a part of your empirical analysis as well. I've been thinking about interaction effects, and particularly because we have, the commission has changed the way it approaches shareholder proposals in terms of giving no action letters within the last year. And there may be further developments there, certainly in the president's executive order on proxy advisory firms. He said maybe rethink 14A8. It may devolve down to state corporate law in some, depending on where the commission goes with that. So I'm thinking, what are the interaction effects between something like mirror voting and pass-through voting, which also exists in the market, but also changes to the shareholder proposal process, things like the retail voting instructions that ExxonMobil was permitted to do this year. I mean, each of these are things that are live, and how would this potentially interact? Any thoughts on that?
At least from a data point of view, we're looking forward to getting the data from next year and being able to run all of that. But at this time, we don't have the data.
So you had a lot of different concepts in there. I would say with regard to any of the considerations that are underway at the commission or otherwise to either change Rule 14A8 or potentially get out of the business of being involved here at all, I think that would not necessarily change from an asset manager's perspective how they would view many of these issues, because I think they still believe that there is a fiduciary duty to vote proxy shares as appropriate, and they would review them regardless. The other piece, though, that I do just want to flag is that, we have been super supportive of the changes to ensure that shareholder proposals are tied to financial materiality and the long-term company value. But, I think we do want to also make sure that there are always those, the proposals that are material still have the ability to get to the shareholders.
What are the statutory predicates for the SEC? If the SEC were to do something in this area, what are the statutory predicates? Thoughts on that? I mean, it would just be under the 40 Act, or no one thought on it? Lindsay, do you have an idea?
So what I would say here is that before we even get to that consideration, we have to make sure that there's a demonstrated problem that warrants the commission getting involved. And then obviously, once we cross that threshold, we would need to determine that the current existing fiduciary law and disclosure framework are insufficient. And then later down the line, we would obviously figure out where the statutory basis would be for it. And it would have to be done, obviously, with the right cost-benefit analysis that takes into consideration all the potential concerns here.
And might I
Professor Fish?
just flag that if the commission were to adopt a rule that took away voting power from some shareholders, it might run into issues under the major questions doctrine?
I think it well could. I'm not sure. I don't want to get into a back and forth on it, but I'm not sure it takes away voting power. I think what it does is it creates a fiduciary expectation for matching the voting strategy to the investment strategy. I mean, and that's the flip side of saying it, right? As opposed to saying.
But so, I mean, mirror voting doesn't match the voting strategy with the investment strategy unless a fund is going to mirror not the general population, but similarly situated investors, right? So if the sustainability index fund mirrored the voting of a variety of Trillium's actively managed green funds, right, that might conceivably work. But, the administrability of that kind of a policy would be awfully difficult. Plus, it's not entirely clear to me that you can assume that investment strategy aligns with voting strategy. I would imagine there are an awful lot of investors in standard index fund products, Russell 2000 indexes and so forth, who might have a preference for a green strategy or a vote with management strategy.
Well said.
I am going to start opening it up. I still have some more questions, but I want to make sure our committee members get the chance. And I think John Gulliver's got his hand to send him first.
Thank you. This issue kind of drives me crazy. I find it very theoretical and also very complex. And I guess my question is a pretty simple one, which is there evidence that there's actually a real problem here? Because I'm not sure I heard any evidence of a problem. I heard a theoretical concern, which essentially is this idea that index investing is going up, index investment funds are fully incentivized to vote their shares or to really invest in the way that they vote their shares, and then I guess presumably that would be bad for the corporate governance of public companies, and then as a result, investors will have negative returns and effects associated with that. But I didn't hear any evidence that actually corporate governance is getting worse at public companies. We see index investing going up, but we don't actually see corporate governance getting worse, do we? If you actually just look at the returns at our markets, they've been incredible. They've been doing better than ever, just while index investing is going up. So I guess my basic question is there any evidence of an actual problem here, or is this more of just a theoretical potential concern?
Yeah, I'll take that off the bat, and then if my fellow panelists want to jump in, that'd be great too. But look, we're seeing an extreme amount of deference in voting given to incumbency by the index and the passive institutions, and especially so over the course of the past 5 years. It may not manifest in how the capital markets are performing, but certainly at the level of the contested situations. I'll just give an example. There have been plenty of election contests over the past 2 proxy seasons where the activist investor has made an extremely solid case for change, so much so that it's resonated with all three of the proxy advisory firms, so that when it comes time a few weeks before the annual meeting and the ultimate election and voting takes place, that each of Glass Lewis, ISS, and Egan-Jones has come out with their recommendation report in favor of the activist investors' case for change. And then when it's come time for the voting, which is usually in the lead up to the annual meeting vote, the business day or three before the vote, we're seeing the passive institution vote come in favor of incumbents and management. And it's been a little bit of a head scratcher. So I do think that if with the trickle-down effect of that could have major consequences if left unchecked for corporate accountability. Because the more management, as the index funds and the passive institutions increase in their scale, and we've seen that over the past 3 decades, such that in some public companies in the U.S., they're collectively 30 to 40% of the outstanding shares. You can liken that to an insider-controlled company if you can be assured as management that those are votes in your pocket. So I think in some basic form in contested situations, it's not necessarily evidence, but coming from my practical standpoint as one that guides activist investors through proxy campaigns, we are seeing important implications and effects in that.
Yeah, so
Lindsay?
thanks for the question, John. So I would say that we have not seen any issue here, and even from what Andrew was talking about there, I think he's bringing up an important point in terms of the proxy advisory firms even potentially supporting some of these shareholder proposals. And what's happening at an asset manager is the asset manager takes in all of the information for each one of these proposals and reviews it and makes the best determination that they can in accordance with their fiduciary duty in the best interests of the fund and the shareholders. And so when that means it's voting with management, that is what they believe the best response to be for that proposal. So when we talk about whether or not this disenfranchises different voters or this just moves influence from one party to another, that's really what we're talking about there. So if mirror voting were to be implemented in that situation, that's exactly an example where the investors would have been, and again, that's done with the expectation that the asset manager is acting on behalf of the investors for their best interests, with the voting guidelines in place and the stewardship policies in place, that they made a different decision than what would happen if we implemented some of these programs on a mandated basis. And I think that's really important to take into account before we decide to mandate any type of program here.
Yeah, just to follow on, I think activist investors, what they do for our capital markets are incredibly important. The evidence clearly shows that when an activist gets involved in a public company, that public company performs better, and that is very important. And that's also particularly complementary to the rise of index investing. If we have more index investment, I think the role of active managers, activist managers becomes even more important to really engage with public companies. So I don't mean to undercut activist investing or their importance with my question. I just think we would need to see clear evidence of a market-wide problem before we start to think seriously about something like mirror voting, which I think would be a major change for shareholders. Professor Fish, I think.
Just to build on that, I think we also have to remember that voting is only part of the process, that a lot of activist engagements and a lot of institutional investor impact takes place through conversations, through negotiations, through settlements, through things that never get to a vote. And one of the reasons that those outcomes are possible is because of the possibility of a vote backing things up. Right? So in Bobby's statistics, we don't have any measure of the number of successful proxy contests that weren't voted on, but where management talked to the big passives and said, we really think we're going to lose. We're going to, concede here. We're not going to take it to a vote. And I think we just have to keep that in mind. If the passives weren't potentially behind that, I think it would be very hard to predict what the outcome would be, and it would make those negotiations a lot more difficult.
It's probably also worth just remembering, too, that the index funds also vote with the shareholder activists a significant amount of the time as well. When the proposals are in the best interest of the fund from their perspective, they also vote that way. So, I think that some of the underlying themes that we get with this conversation is that the index managers always vote with management and that it doesn't allow for these proposals to make it across the finish line. They make it across the finish line when they are worth making it across the finish line from our perspective.
Is there, though, I think there's a difference between a shareholder proposal introduced by someone who might have $2,000 worth of stock on an environmental or social question and the sorts of clients that Andrew has, where you've got someone taking a very large stake, putting a lot of resources, a lot of research behind one company. Their incentive is to drive shareholder value, because if they don't, they're going to be out of business very quickly, right? They're going to lose money. The passive index fund doesn't have that incentive at all. They have an incentive to attract assets under management and to do a good job, and they do a good job. I use passive index funds. But in terms of trying to decide these corporate governance questions, they don't have a lot of skin in the game. Isn't that right?
So I assume that's directed at me.
Well, it's directed at anyone, but probably you or Professor Fish seem to be.
So I think that's also a misconception. So when you look at an index fund, the index fund does not get to choose the underlying holdings because obviously they're tracking an index. So the ability to vote proxies and to engage in this process is one of the only tools that they have in the tool belt for their funds. And that obviously leads to the incentives being also for that company to do well and to succeed, because that obviously reflects back in the fund. So I think it's a little bit, obviously it's a different perspective from the activist investors, and I agree with John that both are necessary in our system and that they have done a lot of good, but it is not true to say that the asset manager doesn't have an incentive to also see the companies, the underlying issuers succeed.
And taken to its logical conclusion, Jim, your argument would essentially say, well, the only people that should vote are the activist hedge funds and management, because they're the only ones with the real incentive and the sort of concentrated stake. And I know that, Exxon's sort of taken the latter view, but, I think that that's not really the way we want shareholder voting to work.
Patrick Doherty.
I'm going to defer for the time being. Thanks. Enjoying the conversation.
Professor Robertson.
Well, thank you, everyone. So I, too, like John, think that activists do really important work for the capital markets. I also think that what we're interested in here is the interests of investors. And so I was really taking seriously Lindsay's view that, is there really a problem that needs to be solved? And I guess with that in mind, I'm trying to think through, and I'm hoping you can help think through the question of, are investors getting what they think they're getting, and would a switch to mirror voting somehow get them closer to what they thought they were getting when they decided to give their money to the management of, say, BlackRock or Vanguard or State Street or T. Rowe or whoever else it was? Do they think that what they're doing is conferring their votes proportionately on the other people in the market who are choosing to vote, or do they think they're giving their capital to Vanguard to be a fiduciary? Because I guess as I think about it, what we're trying to do is empower investors with their capital to do what they wish with it. And then I guess the other piece of that is we've been hearing about sort of financial activists and the voting of financial activists, which is obviously very important. But we also have to take the bitter with the sweet. So there are other types of proposals and other types of proponents in the market, not all of whom put a lot of capital behind what they're doing. And so I wonder, empowering financial activists at the same time as empowering I guess Jill suggested it would only be management or kind of capitally activists, but there are other voters out there as well. And so I just wonder, is empowering only those groups what individual investors who participate in these broad-based diversified index funds think they're doing when they put their capital there?
So to that part of the question, what I would say is that I think investors obviously are choosing among different investment products. They're choosing to invest in an index fund. They're choosing among managers. And when they're doing so recognizing that there's a delegation that's happening for that fiduciary to act on their behalf in a variety of ways, but including with regard to voting. This is why I think asset managers will post their voting guidelines. Whether or not we should talk about, I'm sure that there's improvements that could be made there, but they are posted, and then the votes are also disclosed as well. So there's a check and balance on the system there for investors. I think there's absolutely more we could be doing from an investor education perspective, and I think it's obviously it's a big focus at SIFMA. It's a big focus of the industry. The voter choice programs as well, I think, are also leading to perhaps more investor education here, and having different opportunities for different types of investors that have different risk tolerance, appetite for digging in the weeds, or if they would prefer to have that delegated model, then that's fine as well. But it is absolutely why I am concerned with any mandating of any of these various programs, that it could be that we take something that these investors think that they have, which is a fiduciary that's acting on their behalf, and they won't realize that actually those companies are now being, essentially managed outside of that construct, that no longer can those asset managers act on their behalf in voting proxies.
Now I'll go to Mr. Doherty since he was ahead in the queue.
Yeah, a couple, three thoughts. I'm very attracted to mirror voting because of the efficiency of it, the cost reduction. The main reason people buy index funds is because they are low cost. This could drive cost even lower, it seems to me. I take Professor Fish's point that shareholders may be losing the vote, but I point out that if they do, it's a fully disclosed loss of the vote, because the documents are going to say we're going to do mirror voting, not your vote. Everyone else's vote will be your vote. I'm wondering, I don't know the answer, I'd be interested in this, whether there's some way to to rescind that option so that, yes, we will have mirror voting, but you can opt out, or if not for all matters, then for particular matters, you can opt out and vote yourself. That might make it too complicated and destroy all the cost efficiencies. I don't know. I'm not sure that there's a problem here, considering the very few cases where the result would be changed by going to mirror voting. But I'm open to considering that too, just how big the problem is. The Commission's agenda is pretty full already, and I hate to give them something else to solve that's a small problem, not a big one.
Anyone want to respond to that, or we'll go to the next question? Professor Bishop.
Yeah, so I think one nuance that is to add that I think has been raised by Adriana, Patrick's, and Lindsay's comments here are that I think up until this stage we've really focused on this discussion of mirrored voting around the question of whether or not it would be mandated, like every single index fund must mirror vote. But you could imagine mirror voting simply being like an option on a menu. So to the extent that an investor, to Adriana's point, which is what do investors think that they're getting, it's not entirely clear to the extent that some people think that they're getting a stewardship team that's investigating the vote. I think probably many think they have no idea what they're getting, and simply adding it as an option to the menu, I think would be able to provide, maybe for certain funds or alternatively for certain items and not for other items, might be able to reduce the cost in some of the situations, but still allow investors to get, the stewardship team voting for them in the situations where they want.
And I'll just reiterate that we are, absolutely looking at it among different asset managers. I think Jill mentioned it was one of the options she looked at when she was looking at her own investments. And I do think that investor choice is going to remain important here, and the technological advances that will happen over the next couple years will make questions like your question about could there be a reverse way of looking at it or whatever else, that should all be, sort of fleshed out as we continue to experiment with different proposals, different programs for different types of investors. And, people are putting the smartest minds behind it right now. So we need to make sure that we don't potentially take away from that effort by pushing the commission toward any one action at this point.
And I would just note that there are ETFs in the market today that mirror vote, and that's their policy. And they say, they fully disclose, we don't have stewardship teams, we just apply mirror voting. At least thus far, I haven't seen those products take off, either in terms of lower cost or greater attraction for investors. But, to the extent, again, going back to the question, is there a problem? Is there a market failure? Right? The market is offering this already, so.
Yep. Now just, if you don't mind, I'm going to jump in here just to offer the perspective, because I'm hearing the question surface in a few different ways of what's the concrete problem, what's the issue we're looking to solve for. And sometimes it's the case that it's the problem you don't see coming, or you can't see unless, say, you're situated in my shoes, because I'm the one on the ground floor having discussions with the activist investors. And look, I'm gratified by those who are on the committee and have recognized the extremely important role that activist investors play as a check on the corporate governance system in corporate America. What if they weren't there to play that role? I've had many of my clients bring up to me in the past 2 proxy seasons, becoming disenchanted, disillusioned. They're putting their resources at risk. It's no easy gambit to launch into a proxy fight. It takes a lot of grit, determination, resolve. The resources, are just a small piece of it, and they can even spread into the 7 figures, if not 8. I've had clients, there's a potential for a chilling effect here for activist investors, and I take that very seriously, and I think we all should, because if activist investors are no longer there to play that role, I can see us sinking back to, we can't have the erosion of corporate accountability, and that's the important role that the activists play. And I promise you, I'm seeing in the conversations I'm having with my clients who are shirking away from potential situations of becoming public and taking an investment at a company because they see the shareholder base and they see that it's maybe just a lost cause from the outset. So what happens there, that's a public company whose status quo is going to perpetuate because it's left unchecked. And that's what bothers me, and that's what I see as a problem.
Very important point. I think the great Frederick Bastiat, that which is seen and that which is unseen, it's really important to keep that in mind as we're looking at any of these rules. I want to turn it over now to Professor Georgiev, who has a question.
Well, thank you, Jim. Thank you to the panelists. This was very interesting. I learned a lot about mirror voting, and I think sometimes if we take the position that there isn't maybe a problem here, sometimes the absence of a finding is also a finding, diagnosing that there is there is a problem, but this isn't the solution, which is actually what I want to get to. So, Andrew, you make the case that maybe there is a large segment of the market that isn't as persuadable. That's what I'm hearing. Isn't as persuadable or open to persuasion as you would like it to be. So maybe the solution isn't mirror voting. Maybe the solution is something else. So what other solutions could we imagine to actually make sure that we have engaged voting, informed voting? Because I think we can all agree that we want informed voting. And then before I turn it over to you, I just also want to emphasize something, which is that so much of corporate and securities law is actually built on the availability of the shareholder franchise and shareholder voting. And even in constitutional law decisions like Citizens United, like it or not, actually Justice Alito spoke about the procedures of corporate democracy, meaning shareholders being able to vote, and if they don't like the way the corporation is behaving, then they can vote, and that's why corporations have certain rights. So if you remove those rights, right, if you remove the rights of shareholders to vote, then you may have a lot of unpredictable consequences, and it is a very radical change. But short of that change, what other situations or what other solutions might we think about in order to get kind of more persuadable shareholders?
Well, I wish I had the answer. I've assessed it from the standpoint of mirror voting. I think it's a regime that's workable and makes a lot of sense. I don't know, maybe some of my fellow panelists have explored other solutions. I think the pass-through really doesn't have legs because of the practical limitations of pass-through voting. But if there were other solutions available that made, that sort of started to get at this growing control that the passives have, I'm all ears and open to it.
I'm going to go to Mr. Liu.
Thank you, Jim. Thank you all for your presentations this afternoon. I'm the new member of this committee representing the interests of senior citizens. I heard the expression several times in earlier sessions today about the typical investor, so you can view me as the typical senior citizen investor. My question is going to echo some of the other questions up to now, including, is this all theoretical? Seems to be a minor effect. But Professor Fish's response about not disenfranchising all the shareholders is the particular focus that I want to put to my question, which is, do any of you have a point of view in terms of which of the approaches, and Andrew, you may have just answered this question, would be practically implementable in a way that is easiest for senior citizens to understand, to have greatest transparency, least amount of complexity in our minds?
So the solution that Jeff Schwartz and I have advocated for the last couple of years is facilitating input, but not voting decisions by the ultimate retail investor. So if you own shares in a Vanguard mutual fund and the Exxon annual meeting is coming up, Vanguard provides some sort of site or some sort of mechanism where you can express your view on whether, in fact, Exxon should be permitted to reincorporate in Texas. And that's not going to be binding because obviously not everyone is going to even respond. But then Vanguard at least has the opportunity to get that information and incorporate that information along with the proxy advisor recommendations and the stewardship team research and all of the other inputs into Vanguard's decisions. Now, I admit that that's not perfect, right? But it's relatively low cost. It still leaves the decision-making authority with the professional, with the fiduciary, as opposed to sort of trying to fan it out to retail investors who might not know anything at all. But if there's an issue in which there's sufficient retail interest, I think that interest and that input should be available, and I think that asset managers should be required to solicit it.
And I'll just add to that, I think from everything, again, that I understand and have read up on the mirror voting, kind of the proposed regime, I think it's readily discernible, easy to understand, should be fairly easy to implement. Look, Professor Atkinson's raised some solid procedural issues and granularities that would have to be worked through, but once those are worked through and you deal with the broker non-votes, maybe you deal with just the quorum that's present and take the pro rata from there, but those can, in my view, easily be worked out. You get to a solution that I think is clear, concise, and is workable.
Oh, John Gulliver's got another question.
Great, thank you. Andrew, I thought your comment really hit the nail on the head for me. I mean, my view is if, in fact, the rise of index investing is leading to a decline in activism, then that's a problem that we need to talk about and think about. Why are there ways to address that issue? I haven't seen that evidence, but it may be out there. So that to me was quite helpful. And then, speaking more generally on this space and what is existing or the new policies that are being implemented, voting choice, pass-through. I think what I'm hearing from the panelists is, nothing's perfect. But what I'm also hearing is a lot of innovation and competition in this space. And I think that's a good thing. So, maybe those two comments cut in opposite directions, but I see the market kind of responding to potential, concerns with the fundamental challenge, which is most retail investors and most institutional investors even don't necessarily want to cast, hundreds of thousands of votes. So that's the fundamental challenge I think we're always going to be grappling with. So it's good to see some competition and innovation in the space.
Final thought, and I'll leave enough time. We've got like 5 minutes on my new time allocation for people to respond if they want. So if you want to respond. I'm hearing a lot of sort of binary thinking on this, where it's sort of like you have to have the mirror voting. If you have it, you're disenfranchising shareholders. What if the fiduciary rule were a default rule, right? So that mirror voting would be a default. You have to worry about how you define an index fund. Maybe they want to label it an ESG index fund, so you're getting that sort of engagement. But if you made it a default and then allowed individuals to opt for a voter choice or opt for the shareholder engagement team, that could meaningfully affect how things go in the future, particularly as this share of the market goes, without tying the hands of an individual investor such that they can't be in an index fund unless they want mirror voting. Thoughts, if there are any? If not, I can make a concluding thought.
I think it's super interesting. I don't have much more to it than that, but I hadn't thought of it, from that standpoint.
All right.
So I would say, I think we know default rules are very sticky, all right? And so people will opt out, but most people won't. And I think, Bobby said time and time again, I think very honest with the research, right? This is not an indicator of future performance. And Jill mentioned, right, that we have these engagements that we don't observe. So I don't think it's correct. I think Bobby would agree with me to take their results of no changes in the past as no changes in the future. So it could have very large effects, and the change in the default rule, I think, would still be very substantial.
Yeah, and I would just say, maybe on a parting note, but I'd much prefer, Jim, what you proposed as the default than something that's, to me, as nonsensical as the Exxon retail voting program. That's just basically a power grab for management in the sense that it operates in the manner it does and is for future meeting. I won't even get into, maybe it's a whole nother panel discussion as to how it subverts the proxy solicitation rules under 14A, but that it applies to all future material decision making and votes of shareholders, including those transformational type votes. It's a topic for another day, but maybe that would have been a better solution.
Jim, I would just say that I think it's an interesting idea too, and I think it gets to the point really that we are all concluding here, which is there's plenty of innovation happening right now, and that we need to continue looking at different opportunities and ensuring that whatever we end up coming out with, if anything, still allows for different investors to make different decisions, and at the end of the day, the investor outcomes are improved from where they are today.
Yeah, I totally agree with that. And I would just say that we may also get a lot more real-world evidence, given that there are funds out there and there are voting choice programs that offer mirror voting as an option, right? We will have evidence in the next few years as these programs expand, how many investors would like this solution and how are those votes cast, right? Nate and Bobby are going to be able to study that in comparison to the other votes. We also have the option in some of these programs to continue to delegate to the fund managers, right? And we'll see, well, is that something that investors, when they make the choice affirmatively, is that something that they choose? So I think a default into any plan is potentially problematic. Defaults are sticky, but again, the market and market evolution is going to give us a lot better information to make policy.
I really appreciate all your time. I've learned a lot. We've got still a busy agenda with 2 resolutions to vote on, so I'm going to call it here. I think we get a little break time still, but thank you so much. I really appreciate all the engagement.
Thank you to the afternoon panel. We'll take a 10-minute break and we'll reconvene for our recommendations. All right, welcome back. We have 2 recommendations which come from our investor as owner and as investor as purchaser subcommittees, respectively, and they follow on panels that we had in March of this year. So without further ado, I'll turn it over to Rodney Commages, who is the vice chair of the investor as purchaser subcommittee, to talk about our first recommendation.
Thank you, George, and welcome to our 4 new members. Let me start by thanking the commissioners, the fellow members of the IAC committee, our panelists, and everyone who has contributed to our recommendation around mutual fund proxy reform today. Specifically, I also want to acknowledge Commissioner Pierce raised a number of very thoughtful questions about these recommendations, many of which we had careful discussion in our subcommittees as we brought forward to a recommendation. So appreciate her thoughts, and we'll continue that dialogue going forward. As context and background, back in March the 12th when we held the panel, we heard a consistent message from our panelists that the mutual fund proxy voting framework continues to serve an important purpose. It's about protecting investors and preserving their voice in key governance decisions. But at the same time, it's being increasingly tested by the realities of the proxy system today. Today's funds are navigating a landscape defined by large and highly dispersed retail ownership, multiple levels of intermediation, and practical constraints in how we can engage shareholders. The result is a system where participation is harder to achieve, timelines are longer, proposals are more difficult to pass, and costs are meaningfully higher. Over the last few months, our Investors Purchaser Subcommittee has spent time carefully looking at these dynamics and thinking about what could be done to make a more effective proxy framework. And that continues to be our work and our recommendation from today. Our work has been grounded in a broader perspective that has highlighted a number of discussions that need to be addressed in the longstanding frameworks to continue as intended as market structure and investor behaviors evolve. Whether we're talking about proxy, voting, or disclosure, the question is ultimately the same. Are we able to deliver strong outcomes for our investors in a way that protects them and meets them where they are? We believe now is the time to modernize and improve our fund proxy voting system. At a recommendation level, we broke it into 3 pieces. In the near term, the focus is on making the existing system more effective. That includes giving retail investors more practical and flexible ways to participate, specifically through an opt-in voting mechanics that allow investors to express voting preferences in advance while still retaining full control over their vote. The goal is here to improve participation rates and reduce the need for repeated solicitations without compromising on transparency or investor choice. In the medium term, our recommendations are around the system's core mechanics. This includes exploring whether quorum and approval thresholds can be recalibrated so outcomes still reflect actual investor intent rather than being driven by participation challenges. It also allows funds boards to act more efficiently in defined areas without shareholder approval, while still balancing appropriate safeguards, advance notice, and strong independent director oversight, so that lower impact matters do not trigger costly and lengthy proxy campaigns. We also recommend allowing fund boards to appoint a greater number of independent directors. Over the longer term, our recommendation is the need for more fundamental improvements to proxy infrastructure. This includes how we can communicate more directly between funds and shareholders, and how proxy materials are written, delivered, and accessed. We think the current government framework remains well aligned with how funds are structured and how investors engage today. Across all 3 phases, the objective is consistent: to improve the investor experience, reduce cost and complexity, and ensure that our system continues to capture meaningful investor voice while maintaining investor protections. So today is about taking our recommendations forward. It's an opportunity to reflect on what we've heard, to pressure check the trade-offs, and to submit something from the Investor Advisory Committee with our point of view. Thank you.
So now we'll open it up to members to express their views on the recommendation, and then we'll vote. So I'll get us started. So I'm very happy to support this recommendation. I think it follows nicely from our March 2026 panel, everything that we heard, there was a strong sense of support from the panelists for many of the ideas that we discussed here. I think this recommendation achieves the goal of improving efficiency without any downsides or potential downsides. Of course, as with any of our recommendations, they will have to be carefully studied by the Commission, go through notice and comment rulemaking. But for purposes of making a recommendation, I'm very happy to support it. I also want to emphasize that, of course, the fund proxy voting context has its own idiosyncrasies and its own particular challenges, and this recommendation is only about that context. So many of the ideas discussed here obviously would not be suitable for other shareholder voting contexts, but for the fund proxy voting context, they certainly are. So this recommendation has my support. I know Andrea wants to make some remarks as well, so I'll turn it over to her, and then any other members who want to speak, please raise your placards.
Thank you, George, and thank you, Rodney, and the subcommittee for taking the time to draft the recommendation. I serve as NASA's member, a member of the State Securities Commission, and I'm sympathetic to the concerns that were noted by the panelists and that are outlined in the recommendation. The subcommittee has surfaced real problems that I think do deserve SEC attention, and I appreciate the subcommittee's thoughtful approach to those problems. But overall, the strategies that have been identified tend to dilute rather than enhance shareholder rights, so I cannot, as NASA's representative, affirmatively vote in favor of the draft. Moreover, NASA does not support the recommendation that the Exxon no action letter be expanded in the near term by a more sweeping no action letter. That policy impacts fundamental shareholder rights, and like all the strategies discussed in the recommendation, policy reform deserves notice and comment rulemaking. I really can't emphasize enough how important notice and comment process is for airing legitimate stakeholder concerns like those raised by SIFMA in its comment letter. I thought the panel discussion was excellent. I thought the recommendation was well drafted and balanced, but I think there are other views out there that are worthy of review and consideration by the SEC on this important topic, and so I will be abstaining from the vote. Thank you.
Thank you, Andrea. Any other remarks from our members? Jim?
Like the chairman, I am supportive of this recommendation. We had an excellent panel in the March meeting and heard a lot of evidence about very common sense approaches that we're having difficulty reaching proxy. What I really appreciate about the recommendation and the work Rodney's done is there's sort of a panoply of options that are laid out. It's not unduly prescriptive. I don't know that we have enough evidence to say this is the answer versus that is the answer, but the fact that the commission ought to think about such things, I think, is very compelling based on the evidence we've seen, and I think that the suggestions are modest and varied. So I appreciate it. I do also think that, there are problems in voting markets. And that's the markets and voting are not the same, and that's true when it comes to electing our representatives. It's true when it comes to shareholder voting in public corporation context, and it's certainly true when it comes to these mutual fund votes. So I appreciate the effort, and I want to support it.
Thank you, Jim. Alvin?
Yeah. So I was going to say I join on most of the recommendations. I just can't support the Exxon protocol part of it, and so I think for me, I'd like to see a little bit more evidence as to what the effects of that will be on shareholders going forward. After, I don't think we have enough data on it, and so I myself can't support that part of it. I'm supportive of the rest of the proposal.
Alvin, thank you for the input. We appreciate it. I think it's part of this panel's different points of view. Again, I think the only thing I would say is, as we heard from the panelists and the practice in the industry, is that unlike corporate votes, getting the votes is the key thing, and we almost always get lopsided 95-5 type votes or more in the issue. So it is a little different than corporate voting in the Exxon situation for corporates, but fair input, appreciate it.
Okay, anybody else? Okay, this comes to us at the recommendation of the Investor as Purchaser Subcommittee, and so I will call the vote. All in favor, please say aye.
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 Anyone abstained? Alvin?
I do, Andrea.
Do you abstain or do you, sorry, any noes? I meant to say, are there any noes before we go to the abstentions? No noes, and then 2 abstentions, Alvin and Andrea, and then I have proxies. Sorry, and Adriana. All right, so 3 abstentions, and then I have affirmative proxies from Craig Kanoki and Amy McGarity. So the recommendation passes. Thank you, Rodney. Okay,
Thank you, George.
Now I'll turn it over to John Gulliver, who's going to discuss our recommendation on quarterly versus semi-annual voting, which comes to us at the recommendation of the Investor as Owner Subcommittee.
Thank you, George. I'm going to proceed in 3 parts. First, I'll briefly describe the process by which the Investor as Owner Subcommittee reached our recommendation that the SEC should maintain its requirement that U.S. public companies provide disclosures on a quarterly basis. Second, I will explain why we think our recommendation is in the best interests of investors. And third, I'll offer my personal views on a path forward. I'll then turn it over to the members of the IAC so each member has an opportunity to weigh in with their views on the issue of public company disclosure requirements generally and why they support, do not support, or abstain from the recommendation. And I think we'll then vote. So first, as to process. This recommendation is a follow-up to our March panel where we heard from institutional investors and legal practitioners on public company disclosure reform. The panel specifically focused on 2 issues: the potential shift from mandatory quarterly reporting to a semi-annual disclosure mandate, and potential reforms to Regulation SK that sets the rules for the non-financial disclosures that public companies must make. We chose to focus the panel on these issues because they are important for investors and both are under active consideration by the Commission. Our panelists expressed a clear view that the SEC should not shift from a quarterly disclosure mandate to a semi-annual disclosure mandate, even if public companies retain the option to voluntarily disclose on a quarterly basis, as they would under the SEC's proposal. Our panelists also agreed that the SEC has other ways to reduce disclosure burdens and that certain existing disclosure requirements are unnecessary. For example, panelists recommended establishing a materiality requirement for all non-financial disclosures, reducing overly specific or outdated line item disclosure requirements, and simplifying excessive risk factor disclosure requirements. Following the panel, the IAC met to discuss whether to proceed with the recommendation. We were able to reach consensus that the existing quarterly reporting mandate should not be eliminated. We did not reach a majority consensus on whether there is a need to otherwise reduce disclosure requirements for public companies, and if so, how best to do so. We therefore decided to proceed with a recommendation solely focused on preserving mandatory quarterly reporting requirements for investors because in our view, this is such a fundamental issue. Now I'll shift to why we think our policy recommendation is in the best interests of investors. First, the policy rationale in favor of eliminating mandatory quarterly reporting requirements is not supported by strong evidence. Quarterly disclosure requirements have applied to U.S. public companies since the 1970s, and we think strong evidence is necessary for a major change like eliminating this requirement. The proponents of eliminating quarterly reporting contend that because U.S. companies must disclose on a quarterly basis, they are too focused on short-term profits and do not sufficiently invest in the long term. Commissioner Hurst mentioned that this isn't the primary reason. There's another reason as well, which I'll address, but this is included in the SEC's proposal, and it is commonly put forward as a reason for reducing or eliminating quarterly requirements, so we do address it here. In short, the empirical research doesn't support this short-termism concern, and neither does market reality. As you can see from the front page of the Wall Street Journal or on CNBC every morning, U.S. public companies are investing more than ever in the long term as part of the AI infrastructure build-out. U.S. public companies are leading the way globally in terms of long-term investment in the future. The other reason put forward to eliminate the mandatory quarterly reporting requirement is that doing so would reduce the costs and burdens of being a public company and encourage more small companies to go public. In principle, this is true. Lower compliance costs make public company status marginally more attractive. The question is by how much and whether it is enough to change behavior. Even without a quarterly disclosure requirement, public companies would still need to continuously monitor and track their financials to achieve operational goals. The reduced cost would be in the time spent publicly reporting these results, which the Commission itself estimates at roughly $200,000 per company each fiscal year. It's not clear that this would be enough to move the needle for public companies in terms of compliance costs or to encourage substantially more private companies to go public. On the other hand, we see three clear risks in eliminating the quarterly reporting mandate as included in the recommendation, the draft recommendation. First, investors in companies that elect semi-annual reporting will have less information to act on, and less information leads to worse decisions that can reduce investor returns. Longer gaps between mandated disclosures leave investors with fewer opportunities to spot deteriorating performance or emerging opportunities at public companies, and therefore a weaker basis for valuing securities. This is a particular problem for retail investors that rely on quarterly disclosures and do not have access to other costly proprietary sources of market data to help value their investments. Second, quarterly disclosures promote management accountability and enforce market discipline. Sunlight is the best disinfectant of bad business ideas and reward for good ones. More timely disclosures ensure that capital will flow more efficiently to the businesses that are performing well and have a positive future outlook, and those that are not will be more readily identified. Management of companies that are performing well will therefore have more timely access to capital at a lower cost to invest, and companies that are not performing well will not, and they will be forced to adapt. More efficient capital markets means stronger economic growth that benefits everyone. Third, the majority of empirical evidence, while not unanimous, generally finds that less frequent disclosures increase the cost of capital for public companies, reduce liquidity of their trading markets, and as a result, increase transaction costs for investors. Of course, it's possible that if shifting to semi-annual disclosures is bad for the cost of capital of a public company, U.S. public companies simply won't do it. The UK and EU experience, however, may undermine that mitigating factor. In recent years, the UK and EU moved away from mandatory quarterly reporting, and roughly 90% of UK companies and close to half of EU public companies no longer report quarterly. The evidence does not support that this shift in the UK and the EU has benefited investors or companies in this markets or resulted in more IPOs, but it still happened nonetheless. As for my view on the best path forward, I think the SEC should significantly reduce disclosure burdens for public companies by establishing a materiality standard for all public company disclosures. The SEC should also reduce the burdens of boilerplate risk factor disclosures that public companies must make and eliminate unnecessary line item disclosure requirements. I would support going even further and limiting quarterly disclosure requirements solely to financial statements, at least for smaller public companies. In my view, it is the financial performance of companies that is the most material information relevant to investors' assessment of a company's value and future performance. Maintaining the requirement to disclose only financial statements on a quarterly basis is a good way to strike a balance between reducing compliance burdens on public companies while ensuring investors have the timely information they need to make investment decisions. So with that, I will turn it over to George, and then we'll go around the room so everyone can share their views on this issue, and then we'll vote. George.
Excellent. Thank you, John, and thanks to your work and the work of the entire Investors Owner subcommittee. So I am happy to support this recommendation, and I would like to indicate why. The way I think about these issues is, the first question is, why do we have mandatory disclosure, and do we lose something by doing away with quarterly disclosure requirements? And so we've known for a very long time that disclosure improves the informational efficiency of securities prices, and price is the most important aspect of any purchase. So an investment can be a good investment or a bad investment depending on the price at which you buy it. And the information that is provided as a result of disclosure is impounded in the price of securities. And without information, you can't actually be sure that the security is worth as much as it is worth. And of course, quarterly earnings provide a very strong indicator about the performance of the business, which impacts price. So that's one very commonly accepted rationale for mandatory disclosure. Another rationale is external corporate governance, which involves the monitoring by informational intermediaries such as investment analysts, rating agencies, auditors, hedge funds, and basically ensuring that the market for corporate control and market discipline works. Without information, we can't have market discipline. And quarterly earnings and quarterly reporting is certainly part of that market discipline. Finally, internal corporate governance, just the very process of collecting information, reporting information, coordinating between the various parts of the very complex and large public issuers, public company issuers that we have, improves the management of firms, and there is a lot of research on that as well. And of course, shareholder monitoring cannot occur without information, and mandatory disclosure on a regular basis is part of that disclosure. Now, there is a lot of theoretical evidence, and there is also empirical evidence, though granted, empirical studies in this area are very difficult to conduct for a variety of reasons. But the recommendation, which I'm happy to talk about later, but the recommendation actually cites a meta-analysis which synthesized 250 empirical studies, and this meta-analysis documents positive associations between disclosure on the one hand and firm-level outcomes such as liquidity, cost of capital, analyst coverage, forecast precision, investor trading, and portfolio choices, capital raising, and managerial efficiency. Cost of capital, again, one of those variables, though as with any empirical study, the independent and dependent variables are difficult to specify. The time periods have to be very carefully thought out, controls, and so on. It's very tricky to actually do empirical work in this space, but the evidence that we do have is strongly supportive of a mandatory disclosure system. Now, when we talk about evidence, I think we also have to think about how much evidence do we need to actually back mandatory disclosure, and in this case, quarterly reporting. Do we need evidence that it works all the time, every single day, or is evidence that it works most of the time, or when it really matters with respect to firm-level outcomes, with respect to investor losses, preventing fraud, and so on, do we need evidence that when it matters, it works? And I think it's the latter. Certainly disclosure is a very blunt instrument. It's also very inexpensive compared to prohibitions, compared to ex post liability, and so on. And so in my mind, it's a very good bargain, actually, the quarterly reporting system. Now, when we talk about evidence, we also have to think about how much evidence do we need that this is a problem before we actually undertake such a radical change. And it will be a radical change because we've had this for 50 years. U.S. capital markets have really grown dramatically on the basis of quarterly reporting as specified in the current disclosure regime. And I just don't see enough evidence that such a big change is warranted. Now, maybe additional work can provide that evidence, but the evidence before us, as John said, does not support such a dramatic change. The recommendation and discussions in the policy space frequently, the recommendation mentions and discussions in the policy space frequently mention that perhaps there is disclosure bloat, right? That sometimes disclosure documents are too lengthy, maybe somewhat impenetrable, and so on. But I think a very important question here is how much of that, let's just call it disclosure bloat, is due to mandatory disclosure requirements, and how much of it is due to voluntary disclosure that companies voluntarily choose to provide. And I would submit to you that much of the growth and risk factors is actually not because of a hard and fast requirement by the SEC. It's actually companies putting in additional risk factors, and there's a lot of kind of voluntary disclosure that companies provide. And if we're certainly not going to require companies to prevent companies from disclosing as much as they want. They can voluntarily disclose as much as they want, as long as it's, of course, not materially misleading. And that's what's driving the length of disclosures. And I agree that is a problem. But I think the issue is how do we actually rationalize kind of the voluntary disclosure and improving the quality of the information information that is disclosed, rather than taking a sledgehammer to mandatory disclosure requirements that have worked for a very long time. Finally, it is true that the SEC's proposal and just this general idea of reducing the frequency of disclosure, it's true that it does not prohibit companies from disclosing on a quarterly basis. It gives them the option to disclose on a quarterly basis if they want, and certainly that is true. But the entire idea behind a disclosure system and mandatory disclosure system is to have structured outputs that promote comparability. And so if a set of companies are disclosing semi-annually, another set of companies in the same industry are disclosing on a quarterly basis, then that makes it very difficult to compare. And I think we have to remember that all investment decisions are by their nature comparative decisions. You're always trading off one investment for another, and you need to be able to compare them, and you can't compare them without information. You can't compare apples and oranges. You need to be able to compare based on liquidity, based on risk, based on just a standardized set of variables. So for all of those reasons, I'm very happy to support this recommendation. And again, thank you, John, and the subcommittee for pushing this forward. Please raise your placards and indicate if you want to speak. So I'll turn it over to Andrea, who is joining us online, and then I'll go around the room.
Thank you, George, and thank you, John, for taking the mantle and drafting this recommendation so quickly. It really is a significant amount of time and energy getting pulled into drafting a recommendation like this for a live SEC proposal in less than 3 months after a panel discussion. So thank you very much for doing that. I will be voting in favor of the recommendation. I don't have a lot to add substantively that has not been covered by John, George, but I would like to use my couple of minutes here to give voice to the investors who are out there in the market by noting an interesting letter in the comment file. Someone purporting to represent the 18 million retail investors in the Reddit group known as Wall Street Bets posted a comment to the SEC file. And since we're an advisory committee tasked with giving American investors a voice, I thought I'd quote a few short excerpts from that comment. So according to the commenter, and again, I'm quoting here, quarterly reports are the single most important leveling mechanism between retail and institutional investors in U.S. equity markets. Institutional investors have expert networks, channel checks, alternative data, satellite imagery of retailer parking lots, credit card panel data, and direct management access through conference and one-on-one meetings that cost more than most of our portfolios. The Commission's release talks about reducing costs for issuers. We would like to know what the Commission thinks the cost is to a retail investor of holding a position for 6 months without a single mandatory disclosure from the company. The answer is not zero. The answer is the spread between what insiders know and what we know, multiplied by every share we own during the gap. The Commission was created in 1934 because retail investors got destroyed in a market where the people running the companies knew vastly more than the people buying the stock. The architecture of federal securities regulation is built on the premise that mandatory periodic disclosure narrows that gap. Cutting the frequency of mandatory disclosure in half is not a technical adjustment to a reporting form. It is a partial unwinding of one of the foundational compromises of the 1934 Act. We are people who own stock. We would like to keep being able to find out what is happening at the company whose stock we own more than twice a year. The Commission has spent 90 years making it easier for people like us to participate in public markets on something approaching fair terms. We are asking the Commission not to spend this rulemaking making it harder. Thanks, George.
Thank you, Andrea. And I'll go around the room just by proximity to me. So I'll start with Rodney.
First of all, I want to thank John and the committee for all their hard work and the willingness to hear all the voices and ensure a balanced approach. Accordingly, I have no objections to the recommendation and will be supporting the recommendation. My organization, Vanguard, does continue to review the issue independently and may have a comment as such. More generally, we're very much supportive of ideas to strengthen the IPO market and public markets in general. Public markets provide the best price discovery, liquidity, and transparency. And We think this is an important way for everyday investors to build wealth and diversify their financial situation by profiting for all aspects of innovation in the economy. Thank you.
Thank you, Rodney. Jim.
Thank you, and I would like to also just commend the committee and John in particular on getting this across the finish line. It's a very thoughtful piece of work, and the committee spent a lot of time on it, and I think the process is very open and fair. I am intending to abstain on this vote, which doesn't mean I don't have an opinion. I'm abstaining largely because I think the recommendation is too pointed and too narrow. I am not convinced that the totality of the evidence clearly weighs against this form of experiment, although I do think we should take very seriously the evidence we heard from Fidelity and Citadel, concerns by those in the market. But just as blind people, trying to feel parts of an elephant, you may see one thing and miss another thing when you're trying to assess a decision rule. But I take that very seriously, and more broadly, I think that the laudable goal that the SEC is engaging in here, which is to try to increase the number of public listed companies, and have more companies want to IPO and fewer go private, is probably not particularly related to quarterly reporting of financial numbers. And this is an issue I testified 20 years ago in Congress on this for the first time. It's an issue that's very important to me. It underlies, the commission that John chairs, the concerns about this when it was launched. So I think he and the committee do very much take that goal seriously. And I do as well, and I sort of share the implicit understanding of the recommendation that this isn't going to do a heck of a lot to change that. And the evidence we had from the UK, for instance, that fewer than 10% of the companies actually adopted semi-annual reporting. That's note 62 on page 21 of the rulemaking, the document. I think suggests, A, we shouldn't overly catastrophize this if we do some experimentation on it, but B, we shouldn't expect this to be a panacea. I strongly agree with John's comments when it comes to the notion that reducing the burden of 10-Qs and disclosure more generally would be laudable, and I think would have a much more significant impact on companies' willingness to go public. I agree strongly with Commissioner Peirce's statement this morning that the size of the company may matter. I think scaling back certain disclosure requirements, even if they were mandated on a quarterly basis, could do much good and ought to be considered by the Commission. I strongly agree with the statement made in the report that it is unclear what frequency of periodic reporting would strike the best balance between the benefits and the costs, paraphrasing the back end of that. I do think there's a benefit-cost question here. It's not clear to me which way it cuts. And if I'd had my druthers, we would have said something more along the lines of what John said in his opening remarks, where he was, but obviously we don't have a consensus fully on that on the subcommittee. But I do applaud this effort, and I am going to flesh these thoughts out a little more and submit them into the record as well. Thank you.
Thank you, Jim. Alvin.
Yeah, I'm happy to vote for this. I was going to say, I think there's a sentence in here that really strikes at me. The SEC, and I'm going to quote it, the SEC itself acknowledges that the overall impact of the proposal is uncertain as it depends on the number and type of public companies that elect to shift to semi-annual reporting and the extent to which those companies supplement mandatory disclosures with voluntary disclosures. And I think that's the key for me, has been that I was taken aback by our panel, and which no one was asking for this reform. Right, like I take that very seriously, like because I know the panel was very well constructed, right, getting different viewpoints, and so if it makes me wonder who's the outcry coming from for changing the rule, and in light of the fact that the evidence wasn't really well produced to make that to make a change or to justify a change, I think I have to support the recommendation. I don't think there's a reason to change what is happening currently, and that's about it. That really just was what weighed on my mind, and that, yeah, I'm happy to support it.
Thank you, Alvin. Sergio.
The framework for the proposed recommendation, in my opinion, aligns with the SEC's mission and should allow more private companies to facilitate greater capital formation and increase transparency by transitioning to our public markets. In the past, some privately held companies resisted the transition to going public and thus lacked an ability to raise capital for expansion or create liquidity by going public for investors and early employees. The transition, as many of you know, isn't easy or cheap. Many of the regulatory obligations are costly and take a lot of time. Operationally, not only are the reporting requirements daunting and require meticulous accuracy, but also the frequency can be incredibly demanding, especially for young public companies. Even after being a publicly traded company for only a couple of years, the transition can present reporting challenges. Therefore, presenting public companies the optionality of filing a semi-annual report can incentivize private companies to make the transition and increase participation in public markets. Additionally, the core principle of materiality isn't optional. Capital markets and reasonable investors will dictate the importance of materiality. I appreciate the public comments from many retail investors and echo the importance of quarterly reporting and the access to data to make better investor decisions. A comment I want to ensure I recorded focuses on technology. I'm supporting the recommendation with an eye to the very near future where emerging technology like AI and blockchain will alleviate and automate regulatory filings. Commissioner Peirce mentioned this morning that even if we were not to make quarterly reporting for all companies, should we make it optional for smaller companies? I appreciate her comment since it aligns with my thesis that one size fits all isn't always the best approach to regulations and to a capital market as big as ours. And her point on streamlining reporting is important, and I appreciate an opportunity to build upon this build upon this as a recommendation. These points should incentivize more companies to make the transition to public markets by lowering costs for issuers and overall increase investor protections and lead to more transparent capital markets.
Thank you, Sergio. John.
Thank you, George. I want to applaud John because as we learned earlier today, he put this together in a very accelerated timeline, so highly appreciate that. I will be abstaining. As a new member of this committee, I have not completed my review of this recommendation, so I will be abstaining. Yep. Thanks.
Thank you, John. Adriana Robertson.
Thank you, and thank you to everyone. So I also a new member of the committee, and so I find it difficult because I wasn't involved in the conversations around shaping this proposal. But I confess, as someone who just joined the IAC less than a week ago, it feels to me like a missed opportunity to provide useful feedback. And I think if the proposal had been something like what John said at the end of his remarks, then I think I would happily and enthusiastically vote in support of it. But as it stands, I came into this meeting sort of open-minded about whether I would abstain or vote no. And I remain in that posture, and I'll just say a few things about why. So the first, George, I just disagree with you about the empirical literature. I don't think the weight of the empirical literature is clear one way or the other. And so I just think we truly just don't know. And one of the most frustrating things as a scholar of securities regulation who's an empiricist is that the most basic question we just don't know the answer to. Right? We don't know if mandatory disclosure is good or bad. And we certainly don't know what the optimal amount of mandatory disclosure is. And so I think We just have to accept that we don't know the answer to that, and we should not characterize the evidence in a way that is not consistent with, I think, what the evidence tells us. And so, I think given that we don't know what the optimal amount of disclosure is, we need to be thoughtful, and I would have hoped that the IAC would have taken up the opportunity to think carefully about what the right amount of disclosure is and what the right way to move forward is. Because candidly, just putting forward we oppose the Commission's proposal is not, I think, to me, a terribly useful use of this body's time and talents. And so, as I understand it, this proposal was put together very quickly, and I would love to maybe have taken a little bit more time, especially now that the committee is at full strength, to study the issue and try to come up with more nuanced and sort of detailed proposal. I just want to add, another comment or two to respond to some of the previous remarks that have been made. There's the direct monetary cost of putting together disclosures, but of course we all know that there's second-order costs associated with this as well, in addition to securities liability that attaches for, and even if the statements were not themselves material misstatements, but the threat that a lawyer will state a claim on that basis, that hurts investors too, right? Because to the extent that this creates a tax on the capital markets and makes it so that, companies basically have to pay protection money in order to stay public, in order for investors to be able to participate in those capital markets, that hurts them. And so I hope, on the other hand, of course, financial information is super important, and how else are people supposed to make their decisions? And so truly there are trade-offs here, and truly thinking those through is really, really important. And I hope, and I wish that this proposal had sort of taken up the challenge of trying to figure out what the best path forward is for investors in order to both provide them the most important benefits while also not making it so that public companies have to pay all sorts of costs, direct and indirect, from being public, which of course for the companies that go and remain public comes out of the pockets of investors, and for the companies that don't go public means that many investors will not have the benefit of participating in that. That, like I said, is disappointing to me. And so I will continue, as I listen to the sage thoughts of the other committee members, I will think about it.
Thank you, Adriana. Patrick.
Thank you. I too am a new member, but I had been giving this a lot of thought, doing it also quickly and about at the same time and pace as John Gulliver and others who prepared the recommendation. I have some thoughts to share. The resolution gives us a binary choice. We can either stay where we are now, or we can go to optional biennial reporting. I wish there were more choices than that laid before us, because theoretically there are. It's been said that quarterly reporting, is good for the markets. It lowers the cost of capital. It provides information to investors that they need. Well, if that's true, and I'm no doubt that it is, why do we stop at quarterly reports? Why don't we mandate monthly reports? As some of the materials point out, companies do that internally. So we could mandate monthly reporting. I'm not proposing that, but I make the point that there's a scale here. It's not a binary choice. I'll also say this, it is the Commission's choice. Quarterly reporting was not created by Congress in 1934. It was created by the SEC in the 70s. So it's a matter of regulation, not statute. It's deeply embedded in what we do. I take that point very seriously. But it's a matter of regulation and not statutory revision that's at issue here. I'm inclined to support the SEC's proposal, and not because of short-termism, but rather because of the issue that Commissioner Peirce flagged this morning, which is the cost associated with quarterly reporting. there are two costs. One's a hard cost and one's a soft cost. The hard cost you can quantify at something like $200,000 a year. Now, that's not too much for a mega cap, but that's a lot to pay for an IPO candidate. There are other things that can be done to reduce the cost of going public. This is not the only one or the main one, but it's part of the package. It's also the kind of cost that a newly public company will bear, but only because it's public. When a company goes public, one of the first things it has to do is hire a securities lawyer. Why is that? Private companies don't need securities lawyers. Public companies do because of all the securities regulations that they need to comply with. And changing this modality from quarterly to semi-annually at the option of the company, I emphasize that, won't eliminate all those costs, but it contributes to it in some way. If I did have the opportunity to modify the resolution, I would consider going to something like exempting smaller companies. And if I did that, I would probably do it in conformity with the SEC's other current proposal, which goes from 5 different categories of public companies to 2. I would probably make it optional for the lower of the 2. Actually, there are 3, so maybe the lower of the third lowest or the second lowest. Do I have any other thoughts? Just about the optionality of the semi-annual reporting. It's been pointed out that more frequent reporting decreases the cost of capital. That's probably true, but that's a choice to be made, in my view, by the company, not the government. There will be companies that will say, well, we're going to stay with quarterly reporting because we don't want to have a higher cost of capital, and we want to avoid the other problems that have been cited as reasons to report more frequently. Other companies may disagree. In London, we're told, only 10% of the public companies report semi-annually, but those 10% have made that choice. I don't know what the quantum will be in the U.S. if they're given this opportunity, but I would like the choice to be the company's choice and not the government's. I really appreciate the work that's gone into this. I can't support the proposal. I'm not saying I'm going to vote against it because I haven't heard everyone yet, but I'm either an abstention or a vote against the proposal, with all due respect.
Thank you for this, Patrick. Very helpful. And maybe just a point of clarification. Of course, companies have a choice whether or not to go public or private. And if they stay private, they don't have to report quarterly or semi-annually or annually. And I think actually private companies do have securities lawyers because they also raise capital.
So
and we're giving retail investors now access to private companies. So, I think those are some of the choices that are already embedded in the market.
If I may add one point, you're right, they can stay private, but I think that's a problem. I think we have too few IPOs, and we have to facilitate a greater number of IPOs. We have to also make it easier for public companies to stay public rather than go private or be sold. So this is not the complete solution to that. There are other solutions as well. This is actually one of the smaller points, but it's part of the puzzle in my view. Thank you very much.
Sheldon.
Thank you, John. I also struggle with this, and I'm new. I have discussed this with regulators around the world for 20 years. I am an active global equity manager, so it matters. I always have UK equity exposure. There are big blue chip companies reporting twice a year, Rio Tinto in UK, BHP in Australia. I have no problem with that. With this proposal, I would, like most people, see relief for smaller companies and some streamlining and cost savings. I do think it is the intangibles of the burden are difficult to assess. I'm not sure I buy the argument that it lowers cost of capital. Your equity reporting, I mean, there was something in here about, well, your shares go up on earnings and then it lowers cost of capital, but there's no mention of when you have a bad day on earnings and your shares drop 30%. So, and you could argue that quarterly reporting increases volatility, and I know there's studies, but and I can support it, by the way. I can support it, but I am interested in the quality of earnings, not frequency. And one reason I like UK and some other jurisdictions is because they prohibit some practices that we still have here that I've seen emerging the last 6 months, some disturbing off-balance sheet issues, a bit of pro forma abuse, manipulation quarterly, and more recently, padding reported incomes with unrealized gains in loss-making companies. So those practices are prohibited in Hong Kong, UK, and many other jurisdictions. And that is not a subject for this, but just maybe for another day. But I can support it.
Thank you so much, Sheldon. We've heard so many great ideas, and obviously this proposal or this recommendation doesn't preclude us doing additional things. It's not the end of our work in this space. And so I agree that there is more that we can do, and I hope we will do. John, as the primary draft of the recommendation, do you have anything to say? Any last words before I
don't think so, no. It was great to go around the room, hear everyone's views. Obviously a divergence of views, and that's a good thing, and that's what went into the process of landing here, and it's great to hear the new members' views, and look forward to incorporating them in future recommendations, future panels.
Terrific.
Excuse me, George.
Yeah.
Your last comment is similar to the comment I made during our lunch administrative meeting, where is this the end of this proposal and the recommendation, or can there be more things to do? Again, speaking as a new member, that type of an opportunity to further consider this would be greatly appreciated.
Yeah.
Think about future panels.
For future panels and future recommendations, certainly. As a point of practice, we always build on our recommendations. There are topics that we've visited time and time again, and I'm sure we'll visit them again as a committee over the past 14, 15 years. I'm sure this is one of them because it's just so important that there are so many different viewpoints. Okay, so just for clarity, I will go around the room and record everyone's vote. So I already have, so I vote in favor, and I have proxies for voting in favor by Craig Kanoki and Amy McGarity. Rodney?
I'm going to vote in favor. Yes.
Yeah, thank you. James?
Abstain.
Alvin?
Yes.
Sergio?
Yes.
John?
I abstain.
Thank you. Adriana?
Abstain.
Thank you.
Abstain.
Thank you.
Yes.
Thank you. John?
Yes.
Thank you. The proposal passes. Thank you. The proposal passes. So this.
I also
Oh,
vote
gosh,
yes,
Andrea.
George, it's okay. I know, I'm virtual, but yes, just for the record.
Thank you very much. It's been a long day, but we have a bit more to go. So we have finished our discussion of the two recommendations. Both recommendations have been approved, and we will hear remarks from the chairman shortly. We will take a short break until then. Okay, welcome back. We are happy to be joined by Chairman Atkins for remarks. Chairman?
So thank you very much. Good to see you all here. And I really am sorry that I couldn't join you this morning at the start of your meeting, and unfortunately I had some contemporaneous official business that prevented me from attending the opening remarks and the portion of today's program. But I couldn't let this quarterly gathering pass without taking a few moments to express my sincere gratitude for your continued and spirited, I understand, service, which is great. So I'll keep my remarks brief because I know that for many of you, the only thing standing between me and your flight home is me. And so save DC traffic, of course, and if you ever try to go over the 14th Street Bridge this time of day, it ain't pretty, I'll say that much. So although there'll be few as far as my remarks go, I still have to do the customary note that and disclaimer that the views I express here today are my own as chairman and don't necessarily reflect those of the SEC as an institution or my fellow commissioners. But to begin, I should especially like to recognize those of you for whom today marks your first IAC meeting as new members. So Patrick and John, Sheldon and Adriana, you've joined an esteemed group whose collective expertise and perspectives make this committee an indispensable partner for us at the Commission in safeguarding investors and strengthening our markets. And now your individual contributions will only augment this collaboration and the insights that arise from it. Serving the investing public with your time and talent is a worthy and high calling, so I very much commend your decision to answer it and collaborate with us to make sure it comes through. And I'd be remiss also not to take this moment to congratulate the new members of IAC's Executive Committee and those of you who are serving new positions within it. So George and Andera, Amy, and John, as well as the new subcommittee members. I'm confident that your leadership will prove instrumental in advancing the critical work of this committee to fortify the foundations upon which our markets depend. So indeed, the promise of your stewardship was already made evident in today's meeting, during which you all convened expert panels and considered several topics of great importance to investors and to the Commission alike. Your first panel this morning examined investor protection challenges and opportunities that are presented by expanding retail access to the private markets. Embracing growth and innovation across all asset classes and promoting orderly markets and investor protection are not mutually exclusive aims. They are compatible goals. So they must be treated not as adversaries, but as allies. And your perspectives on the issue will help inform how the Commission can meet both objectives as we consider our role in increasing exposure to the full dynamism of our capital markets with appropriate safeguards. The second panel today contemplated the increasing concentration of voting power in passive investment vehicles and its effects on investor protection. Assessing and, where warranted, addressing how these passive vehicles vote and the influence of proxy advisors on their vote has been a priority under my leadership because of its profound implications for corporate governance and, in the context of funds, for advisors' fundamental fiduciary duty to act in their clients' best interest. I'll continue to emphasize that investment advisors as fiduciaries must vote client proxies in their clients' best interests and not their own. Both of these discussions, I'm certain, yielded valuable insights for which I'm most grateful, and I look forward to engaging in the coming months on the consequential work that you all explored today as we continue to steer the SEC back to the bedrock fundamentals in which our mandate is rooted. As we do so, I'm grateful for the acumen and the thoughtfulness that you bring to every investor advisory committee meeting, always with the investors' interests foremost in mind. So let me close by extending my special thanks to the Office of Investor Advocate, the staff, and for the hard work in organizing this meeting. And congratulations once again to our new members and our executive committee. So thank you all for your time and engagement today, and I look forward to the work ahead. Thanks very much.
Thank you, Chairman Atkins. This concludes today's meeting. Thanks, everyone, for participating, and see you in September.
September will be here before you know it. So anyway, right, so already June.
Enjoy summer on less, right?
Yeah, exactly. So, all right. So, well, good. Well, thanks for all your work. Yeah.